The Strategist's Blueprint: Mastering Mindset, Structure, and Execution in Volatile Markets. Copyright 2026 Anthony Jones, all rights reserved. At Stocks Updated Daily. The Strategist's Blueprint: Mastering Mindset, Structure, and Execution in Volatile Markets. Dedication and Purpose. This book is far more than a collection of trading lessons. It is a tactical blueprint forged in the fires of real-world market experience, hard-earned wisdom, and a relentless pursuit of mastery. Within the world's most volatile arenas, every insight contained in these pages is drawn directly from the wins that built my confidence and the losses that sharpened my discipline. Knowledge alone is merely potential. Applied knowledge is transformation. That exact transformation is what this book is designed to spark. I have gathered the precise notes, strategies, and psychological shifts that turn my personal setbacks into stepping stones. I am sharing them openly so that you do not have to learn these lessons the hard way. Far too many traders fail, not because they lack potential, but because they lack structural guidance, proper risk management, the Strategist's Blueprint, Mastering Mindset, Structure, and Execution in Volatile Markets, emotional maturity, and a definitive plan. This book is designed to bridge that gap. As you progress through these chapters, you will develop a deep, actionable understanding of technical analysis, candlestick patterns, intraday setups, market structure, and both fundamental and technical execution models. Whether your vehicle of choice is equities, cryptocurrency, options, or futures, the ultimate objective remains identical: to elevate your operational mindset, sharpen your technical execution, and empower you to produce consistent, confident, and sustainable results. This is not merely a trading guide. It is a foundational mindset shift. It is a calculated push toward becoming the professional trader you are capable of being. It serves as a permanent reminder that when you pair clinical strategy with unwavering discipline, market success ceases to be a matter of luck. It becomes inevitable. The Strategist's Blueprint: Mastering Mindset, Structure, and Execution in Volatile Markets. The Strategist's Blueprint: Mastering Mindset, Structure, and Execution in Volatile Markets. Table of Contents. The Strategist's Blueprint: Mastering Mindset, Structure, and Execution in Volatile Markets. Introduction. In a modern economic landscape where the ground is constantly shifting beneath our feet, characterized by stubborn inflation, climbing living costs, and erratic swings in the prices of everyday essentials, relying on a single income stream is no longer just risky. It is a critical vulnerability. For a vast majority of working professionals, financial pressure can feel like a crushing, permanent weight. Yet, wrapped within this stark reality lies an extraordinary opportunity: the chance to develop a specialized, high-income skill set that can permanently alter the trajectory of your financial life. Trading is one of those rare, transcendent skills. It teaches you how to take a calculated portion of what you earn and multiply it, sometimes systematically and steadily, and other times astonishingly fast. Once you master the ability to read market data with analytical clarity and clinical discipline, that knowledge becomes a permanent asset. No matter what occurs on the global political stage, and no matter how unpredictable macroeconomics become, you will always possess a personal mechanism to generate liquidity and grow capital. Armed with the right information and the proper psychological framework, you effectively become your own source of economic opportunity. However, the market is an incredibly powerful entity, and power demands absolute respect. The market possesses the capacity to build life-changing wealth, but it will seamlessly destroy your capital if it is approached without strict intention. Losses will happen. If you are unprepared, they will shatter your confidence and trick you into making emotional, reactionary decisions you never thought you were capable of making. I know this because I have lived it. Early in my journey, my sheer determination to succeed kept me afloat, but that same unrefined ambition frequently blinded me to risk, steering me directly into devastating mistakes. I have lost far more than just paper profits. I have watched hard-earned savings vanish. I have felt the bitter sting of revenge trading, the profound frustration of watching my discipline erode in real time, and the compounding weight of financial setbacks that seemed utterly impossible to recover from. Yet, looking back, those dark moments were my ultimate turning points. They forced me to self-reflect, to restructure my approach, and to rebuild from the ground up. They broke my bad habits and rebuilt me into a trader defined by resilience, patience, and absolute technical clarity. During those volatile periods, I deeply wished I had a comprehensive guide like this book, a rational voice to warn me, to ground me, and to help me navigate the emotional and financial storms I routinely walked into. Every challenge, however, carried a vital lesson. In the end, those setbacks provided the exact friction required to build my professional edge. I was blessed with the opportunity to rise again from what felt like rock bottom. Even when bills were accumulating, debt felt overwhelming, and internal doubt screamed louder than my conviction, I kept showing up. That is precisely why this book exists, to serve as your defensive shield against the mistakes I made, to drastically shorten your learning curve, and to fortify your psychology before the market ever has the chance to test it. The strategies detailed in this book are not mythical secrets. They are timeless, structural principles that work, but only if you possess the discipline to rigidly apply them. It is remarkably easy to say you will change your habits. It is vastly more difficult to execute that change when real money is on the line. Successful trading is built upon two core pillars, psychology and technical analysis. When you master the intersection of both, you grant yourself the power to unlock consistent, long-term profitability. The professional trader's creed: 1. Plan your trade. 2. Define your risk. 3. Stick to your plan. The financial markets are teeming with unparalleled opportunity, rapid intraday gains, compounding long-term growth, and the structural freedom to dictate your financial future. But those rewards are structurally tethered to extreme volatility. Prices fluctuate, trends shift, and regime changes occur without warning. One day you are riding an equity high, the next, the market pulls back violently. This is the organic nature of the game. It should not be feared. It must be understood, managed, and capitalized upon. You do not need to avoid market volatility. You simply need to approach it with institutional wisdom, surgical strategy, and total self-awareness. When you do, you position yourself to build an extraordinary financial legacy. Let this book serve as your structural guide, your technical foundation, and your distinct market advantage. If you fully commit to this process, this text will mark the definitive beginning of your transformation, not just as a market participant, but as an individual. Chapter 1: Mindset and Wealth Preservation. 1. Architectural knowledge, the ultimate power source. The definitive reason a staggering percentage of retail participants suffer catastrophic losses in the market is simple. They enter the arena with deficient, surface-level knowledge. The stock market is a hyper-competitive environment. Unless you understand its structural mechanics, order flow, and underlying realities, the market will systematically extract your capital. A little knowledge is an exceedingly dangerous thing. You must thoroughly equip yourself with an understanding of market mechanics. Master the pricing models of assets so you can objectively evaluate probabilities rather than gambling on blind hope. Furthermore, understand that the financial markets and the broader macroeconomic climate are intrinsically linked. When you approach the market through a lens of deep operational knowledge, you naturally insulate yourself from the rookie mistakes that break accounts. Build your informational foundation first. Only then should you deploy capital. 2. Rigorous independent research versus the herd mentality. If you currently suffer from a herd mentality, buying assets simply because they are trending on social media or popular among retail forums, you must abandon this habit immediately. The professional trader never buys an asset solely because it is popular. You must conduct meticulous independent research before risking a single dollar. Whether you are looking at an intraday equity setup or a long-term core investment, you must evaluate the underlying metrics, structural support and resistance levels, fundamental health, market capitalization, volume profiles, and prevailing market sentiment. If an asset boasts robust institutional backing, liquid volume, and clean technical structure, it provides a reliable canvas for risk management. Relying blindly on a broker, an online guru, or a trending forum is an admission that you do not know what you are doing. Take responsibility for your data, analyze the charts yourself, and always make an informed, independent choice. 3. Maintaining tactical perspective. While day trading and swing trading provide unparalleled avenues for generating rapid income, You must maintain a clear perspective on asset behavior. There are no magical shortcuts to sustainable profitability. While it is entirely possible to capture explosive, short-term momentum during parabolic market phases, long-term capital preservation relies on respecting broader cycles. Understanding higher time-frame trends drastically reduces the psychological friction and inherent risks associated with lower time-frame execution. Historically, broad market indexes demonstrate a structural reality. Despite violent macroeconomic shocks or brief panic sell-offs, liquid markets eventually rotate, recover, and establish new highs. If your operational vision is myopic, meaning you panic at the sight of a minor red candle or a temporary pullback, mitigating losses will be impossible. Give your setups room to breathe based on technical parameters, align your trades with dominant market trends, and never let micro movements dictate your macro execution. 4. The past performance fallacy. A classic trap for developing traders is relying strictly on historical metrics or past performance to dictate future expectations. A stellar historic track record is never an absolute guarantee of future returns. Corporate history is littered with fallen giants that maintain pristine reputations for decades right up until structural shifts or hidden vulnerabilities triggered a total collapse. Historical data is a piece of the puzzle, not the entire picture. Plain text. Historical performance not equal to guaranteed future return. To truly assess an asset, you must dissect its current technical health and its immediate market environment. Analyze its relative value metrics, its volume profile, and whether it is technically overextended or structurally undervalued. Buying a severely overextended asset near historical resistance leaves you highly vulnerable to major pullbacks. Conversely, identifying high-volume, fundamentally sound assets emerging from clean accumulation structures yields asymmetric risk-to-reward ratios. Base your risk on current, live market conditions, not on what an asset did last year. 5. The magic of automated stop-loss management in the market. Potential upside can be exponential, but a managed downside will run your account straight into the ground. The single most effective tool for neutralizing catastrophic risk is the disciplined execution of a stop-loss order. A stop-loss is a definitive instruction given to your broker to automatically liquidate a position when an asset hits a predetermined price level. This mechanic is your primary defense mechanism when a trade invalidates. By exiting precisely at your technical invalidation point, you permanently prevent a minor, manageable loss from mutating into an account-ending disaster. Practical example. Imagine you enter an equity position at $1,500. Based on your structural analysis, if the price drops below support at $1,350, the bullish thesis is entirely void. You place a hard stop-loss order at $1,350. If the market drops and tags that level, you are automatically liquidated. You accept a controlled, calculated loss. If the asset continues to plummet to $1,000, your capital remains completely protected from that further devaluation. If the asset instead rips upward, your stop-loss remains untouched, allowing your profits to run unrestricted. Never trade without a defined invalidation level. Calculate your exact risk before entry, place your stop-loss immediately upon execution, and let the numbers do their job. 6. Divorcing emotion from execution. How frequently have you allowed fear, greed, or hope to dictate your execution? In the professional trading arena, clinical practicality is the only currency that matters. Emotion is a direct liability. The moment you allow feelings to govern your buying and selling, you have guaranteed a loss. To protect your capital, you must operate with a completely detached, analytical psychological framework. Remember, market cycles are temporary. Parabolic bullish runs will inevitably exhaust themselves and transition into bearish distributions. Conversely, brutal downtrends will eventually exhaust themselves, find a floor, and accumulate. The market is a continuous wave of structural rotations. To thrive, you must view these waves with total objectivity. When the market is hyper-bullish and euphoria peaks, do not let FOMO trick you into over-leveraging or chasing overextended tops. Slow down. When the market panics and aggressively pulls back, do not capitulate to blind fear by liquidating long-term holdings at absolute support. Stay calm and evaluate the structure. Emotional decisions are almost always wrong. A clinical trader weighs the raw technical data, calculates the risk-to-reward ratio, and executes with cold, detached precision. 7. Strategic diversification and its limits. The age-old maxim, don't put all your eggs in one basket, remains a foundational pillar of risk mitigation. If you distribute your capital across uncorrelated assets, a sudden shock to one specific sector or asset class will not completely compromise your net worth. Proper asset diversification is an excellent shield against black swan events. If you hold positions across distinct, uncorrelated industries, underperformance in one sector is naturally balanced by expansion in another. We witnessed this clearly during recent global disruptions, while manufacturing and hospitality assets suffered aggressively due to supply chain locks. Pharmaceutical, technology, and consumer staple sectors experienced massive capital inflows. Traders who maintain a diversified approach saw their portfolios stay resilient because their varied exposure neutralized sector-specific shocks. However, a critical warning must be issued: do not over-diversify. Over-diversification is a direct path to mediocrity. If your portfolio is diluted across 50 different assets, your winning trades will fail to move the needle on your overall account balance, while your tracking and management of those positions becomes chaotic. Diversify with strict logic and purpose. Maintain a concentrated focus on a few highly liquid, high-probability sectors, and never dilute your capital to the point where your mathematical edge vanishes. 8. Hedging as a defensive discipline. Hedging is a highly sophisticated tactic designed to insulate your capital from adverse market shifts. True hedging involves opening a secondary position that is mathematically structured to generate profits if your primary investment incurs a loss. In active trading, this can be achieved seamlessly via derivatives such as futures contracts or options. Alternatively, during periods of extreme macroeconomic turmoil, macro hedging can be accomplished by rotating a percentage of capital into safe haven assets like gold or cash. Historically, when broader equity markets experience violent distributions, gold and uncorrelated commodities tend to capture strong capital inflows. Utilizing options, futures, or alternative assets to construct a protective hedge ensures that your portfolio remains protected even when broad market indexes are under severe pressure. 9. The commitment to continuous education. Market mastery is an infinite process of learning. Exchange rules change, algorithmic behavior adapts, macro environments shift, and technical landscapes constantly evolve. Therefore, you must commit to an uninterrupted journey of self-education. You must continuously study the mechanical shifts within the specific assets you trade. Mastering this game requires an in-depth, nuanced understanding of order flow and market dynamics. Dedicate yourself to analyzing institutional strategies, reading advanced financial literature, studying the playbooks of market legends, and aggressively expanding your own technical knowledge base. Simultaneously, stay intensely attuned to global macroeconomic data releases, such as CPI inflation prints, interest rate decisions, and employment reports, as these events provide the raw catalyst for massive intraday volume and trend reversals. Treat trading as a profession and remain a perpetual student of the charts. Mindset 101. The laws of adaptability. Markets are dynamic organisms that shift rapidly. To survive, you must be prepared to instantly pivot your tactical approach based on live data and evolving technical structures. The modern intraday environment can be highly irrational. Always remember the timeless market wisdom: the market can remain irrational far longer than you can remain solvent. At times, the scenarios that make the least logical sense are precisely what will manifest on the tape. To navigate this reality, you must operate with zero bias. You must maintain a comprehensive trade plan for both directions, bullish and bearish. Never marry a thesis. Pay meticulous attention to critical macro price levels, major daily support and resistance zones, overextended RSI metrics, and, above all, the prevailing volume profiles on the daily chart. Plain text: execute bullish plan, initial setup, execute bearish plan, plan your trade, define your risk, stick to your plan. The end-of-day options specification model. Executing option strategies in the final hours of the trading session offers unique, highly lucrative structural advantages. Near the daily close, option premiums experience rapid theta decay, heavily deflating the cost of contracts. When executed with surgical precision, This environment allows a disciplined trader to control risk with minimal capital outlays while targeting massive, asymmetric risk-to-reward ratios. However, extracting consistent gains from the end-of-day market requires a level of psychological control, patience, and execution discipline that few retail traders possess. First, capital isolation via low-cost contracts. As the closing bell approaches, options premiums naturally cheapen due to the relentless acceleration of time decay. This structural dynamic enables you to enter highly liquid positions utilizing a fraction of your standard capital while fully retaining explosive percentage gain potential. The rule: commit only a designated, minor suballocation of your daily capital to these specific later-day setups. The structural objective is never to deploy heavy leverage or risk account health. It is to surgically capitalize on heavily discounted premium pricing. The warning: avoid buying expensive, deeply out-of-the-money or highly inflated contracts late in the afternoon. When you pay inflated prices close to expiration, your risk-to-reward ratio deteriorates instantly. Second, the law of late-day entries. An elite trader operates with immense tactical patience, entirely avoiding the midday noise and waiting until approximately 1:50 p.m. to 2 p.m. before mapping out new intraday options positions. By waiting for this specific execution window, you gain three major structural advantages. 1. The chaotic, unpredictable volatility of the morning session has completely subsided. 2. Intraday options premiums have shed their inflated extrinsic value via time decay. 3. The true institutional direction and volume trend. 4. The daily close are clearly readable on the chart. Entering positions prior to this window exposes you to elevated premium pricing and erratic, directionless whipsaws. Third, the reality of inflated morning premiums at the opening bell. Implied volatility is structurally elevated. This causes options contracts, specifically calls, to be traded at heavily inflated premiums. If you buy options immediately at the open, you are paying an extreme premium tax. Buying inflated pricing drastically compresses your eventual profit margins while multiplying your immediate downside risk if the trade stalls. Waiting for the morning volatility to settle allows the premium pricing to normalize, giving you a cleaner technical entry. Fourth, the first 15 minutes as a macro signal. The opening 15 minutes of the trading session provide a vital structural blueprint regarding institutional intent for the entire day. Treat this period as an analytical charting window, never as an active execution window. Plain text: 9:30 a.m. EST, 9:45 a.m. EST. Sustained buying above open equal to bullish bias. Sustained selling below open equal to bearish bias. Sustained upward momentum. If the asset cleanly drives above the opening print on high volume, it signals a strong bullish daily bias. Sustained selling pressure. If the asset aggressively breaks below the opening print, it indicates a dominant bearish bias. Failure to hold early moves. If the asset rips and immediately collapses back through the open, it signals structural indecision and range-bound chop. The action: use this critical window strictly to observe volume and identify key levels, not to force hasty entries. Fifth, gap analysis mechanics. Gaps between the prior day's closing price and the current day's opening print exert an immense structural influence on early daily momentum. Gap-up structures indicate significant overnight bullish sentiment. Long options may become highly viable only after a clean technical confirmation, such as a successful retest of the opening range or a gap fill-in bounce. Gap-down structures indicates dominant overnight bearish sentiment. Short options become viable only after technical confirmation, such as a failed bear flag retest of the previous day's close. The golden rule: gaps frequently trap retail traders via instant reversals. Never blindly chase a gap at the open, always wait for price action to confirm structural validation. Sixth, total elimination of overtrading. Overtrading is an express route to account destruction, particularly within the options arena where leverage and rapid premium decay amplify every single error. Late day trading must be approached with an ultra-selective filter. Deploy fewer individual trades. Only execute on pristine, textbook setups. Maintain a rigidly defined risk parameter. If the market does not present a high probability, structurally verified opportunity during the late day window, the absolute correct professional decision is to remain flat. Cash is a valid technical position. Seventh, scaling position sizes globally. Regardless of whether you are managing a $5,000 account or a $500,000 portfolio, your position sizing must remain strictly conservative. Adopt this permanent mental framework. Execute every trade as if you are managing a highly restricted, small account. This psychological constraint completely eliminates emotional, ego-driven decision-making and ensures your capital is fully insulated during inevitable losing streaks. A large account balance does not shield you from risk. It merely magnifies the financial consequences of your undisciplined mistakes. Neutralizing the midday lull. The specific period between 11:30 a.m. and 2:30 p.m. is highly dangerous for retail traders. It is characterized by severely deflated institutional volume, declining liquidity, and erratic, algorithmically driven price action. This midday lull routinely prints deceptive false breakouts and false breakdowns that lack any real volume follow-through. It is one of the lowest probability environments to trade active options. Professional traders routinely step away from their terminals during these hours to preserve their mental clarity, maintain focus, and protect their hard-earned morning capital. The core pillars of capital capitalization. Patience is a definitive competitive edge. Mitigated risk parameters yield permanent consistency. Delayed entries ensure superior premium pricing. Systemic discipline will always matter more than trade frequency. Day execution is never about forcing trades out of desperation or boredom. It is about waiting patiently for the market to hand you an asymmetric mathematical advantage. Patience plus strategy equal to professional gratification. Chapter 2: The Options Tactical Trading Framework. Successful options execution requires absolute precision, flawless preparation, and an institutional respect for premium mechanics. This framework is anchored by an unyielding operational hierarchy, protecting your capital first, expanding your account balance second, and executing positions only when the market presents a clear, high probability structural advantage. Every decision you make at your terminal must be intentional, deeply analytical, and grounded in raw market structure. 1. Decoding premium behavior. The ultimate truth signal in the options market. Contract premium reveals the absolute truth long before the underlying equity chart prints a definitive move. The most reliable technical signals are derived by closely tracking how deep in the money options behave across the trading session, particularly during the final hour when volatility cycles accelerate. Carefully monitor ITM premium expansion and contraction relative to major price levels throughout the session. The 6-strike rule. Identify 6 ITM strikes relative to the previous day's closing price. Wait patiently for that specific premium volatility to cool and stabilize before mapping your entry. Let premium velocity dictate your timing. Premium fluctuations frequently telegraph underlying institutional momentum shifts minutes before those shifts are confirmed on a standard candlestick chart. Plain text: institutional momentum shift. Option premium expands. Candlestick chart prints breakout premium is your definitive tactical compass. Once you master the ability to read its internal velocity, you completely cease guessing and begin anticipating. 2. Preparation. The pre-market blueprint. A truly professional tactical trader arrives at the opening bell with a highly structured battle plan, never a blank screen. Before the market open, formulate multiple conditional scenarios based on overnight futures data, global market structure, and pre-market volume behavior. Map out major support and resistance zones, ensuring your chart displays the pre-market high, pre-market low, volume-weighted average price, and major institutional liquidity pools. Dynamically update these key technical levels as the live session unfolds. The market is a fluid environment. Your plan must adapt in real time to incoming data. Meticulous preparation completely eliminates inter-session hesitation. When the opening bell rings, you must already know exactly what structural anomalies you are looking for. 3. Execution protocols. Precision over impulse. Impulsive, unverified trades destroy trading accounts. Tactical, rule-based trades build wealth. Your execution protocols must be absolute and non-negotiable. Only initiate entries at major macro levels of interest. Prioritize ITM contracts that are rapidly gaining intrinsic value, as they offer cleaner, highly predictable premium expansion and insulation from theta decay. Utilize precise mathematical models to project exactly what your target contract Premium should be priced at T when the underlying equity tags your technical resistance or support targets. Execute an entry only when your trade plan aligns perfectly across 3 domains: market structure, premium pricing, and macro timing. Every single trade must possess a clear, logical purpose. If you cannot explain the structural thesis behind a trade in 2 clear sentences, you have no business taking the position. 4. Profit. Taking disciplined paper profits are an illusion. Capital is only real once it is locked into your balance. High beta vehicles move with immense velocity, and intraday reversals can materialize in a matter of seconds, if an out of the money contract scales into the money near the daily close. Liquidate and lock in profits immediately. Always have your sell limit orders prestige for execution. Maintain a strict mathematical plan for tracking premium drawdowns and executing technical recoveries. Tactical playbook example: you execute an entry at a premium price of 10. The contract premium drops to 2 due to an aggressive shakeout. If your higher time frame thesis remains structurally valid, your recovery plan must be to scale out or take profit around a premium price of 6 on the inevitable technical bounce. Only scalp OTM contracts during high volume, clean structural breakouts or breakdowns, and extract your profits rapidly. These contracts can double in value in minutes and evaporate to zero just as fast. Your operational job is never to perfectly predict the exact top of a move percent. It is to systematically extract cash from the market and secure the gain. 5. Adaptive market navigation. Varying market regimes demand completely distinct tactical approaches. You must master the ability to read the current environment. Plain text. Market regime execution strategy. F. Tactical. H. Or choppy volatile or scalping technician or range-bound short resistance buy support session. Do not fight institutional closing volume. Restrict your late day SPX operations exclusively to highly liquid contracts that reached a minimum premium value of 5,000 earlier in the session. Completely avoid illiquid contracts whose high of day premium capped out around 2,000. The 1-free premium ratio model. If a contract premium moves exponentially from a value of 100 to 300, expect an immediate, violent technical retracement unless the prevailing trend is exceptionally strong. Late day execution rewards cold, calculating discipline. It systematically destroys hope. 7. Core risk priorities. Your operational hierarchy is simple, elegant, and permanent. 1. Preserve your total account balance. 2. Grow your total account balance. Account growth is mathematically impossible without absolute capital protection. 8. Institutional open interest dissection. Prior to executing a late day option position, analyze the options chain to isolate the highest concentrations of open interest across the AT. Money call and put strikes. High open interest reveals exactly where major institutional liquidity is clustered and where market makers are forced to hedge their positions. This data gives you a clear map of potential daily magnet levels. 9. Structural trade requirements. Before you click the buy button, every single trade must rigidly satisfy these criteria. Provide 3 distinct, independent technical reasons for entering the position. Establish your exact profit-taking target prior to entry. Identify your structural hedge level, particularly when executing trades close to the daily bell. Document your plan in writing. Note the key technical levels, immediate support and resistance parameters, pre-market structure, and live premium behavior AT the high and low of the day. Addendum to the pre-market blueprint, leveraging artificial intelligence for chart architecture analysis. In the modern digital trading landscape, artificial intelligence serves as a powerful co-pilot for technical analysis. Rather than relying solely on manual inspection, an elite trader can capture a high-resolution snapshot of a live chart and upload it directly into an advanced AI model to secure a rapid, objective, and multi-dimensional structural breakdown. However, the quality of an AI's output is strictly dependent on the specificity of your input. To extract institutional-grade insights, you must abandon vague questions like, should I buy this? And instead demand precise structural analysis across 6 core operational categories. The Sovereign Technical Prompt Framework. When submitting a chart for AI diagnostic analysis, structure your query to evaluate the following data fields: trend and market structure. Demand an objective assessment of the primary, secondary, and lower time frame trends. Is the asset printing structural higher highs and higher lows, or is it locked in a distribution phase? Determine if the price action is deeply extended from its baseline or early in a structural expansion. Support and resistance geometry. Order the AI to isolate major daily and weekly support resistance levels, key institutional liquidity pockets, and immediate order blocks. Determine whether the current consolidation pattern points toward accumulation or distribution. Indicators and divergence confirmation require a thorough examination of momentum indicators relative to price action. Is the RSI displaying a clear bullish or bearish divergence? Is price actively respecting VWAP and key exponential moving averages, or is momentum fading on the lower time frames? Candlestick mechanics and volume validation force the AI to analyze the most recent candle prints. Does the tape reveal an authentic breakout, a minor pullback, or a clear liquidity trap, fake out? Crucially, demand validation of the price move via relative volume analysis, contextual and sector analysis. Instruct the AI to cross-reference the chart against the broader market indexes. Is this specific ticker showing relative strength as a market leader, or is it a lagging asset within its sector? Trade execution planning. Request a high probability trade blueprint based purely on the technical data. Establish the precise invalidation level, the structural stop, loss placement, a realistic profit target, and a definitive risk-reward matrix. Use AI prompts. The professional prompting paradigm. Weak inquiry. Is this chart bullish or bearish? Should I buy calls? The professional prompt. What is the absolute highest probability trade setup on this chart? Where is the structural thesis proven wrong? And what specific volume or candlestick signal confirms the entry? The tactical AI prompt library. Use these 5 pre-engineered high conviction templates to streamline your pre-market and intra-session analysis. Prompt 1. The weekly macro catalyst and strat watch list plaintext. ACT, as an expert options trader and macro strategist, provide a curated watch list of 5 high probability tickers for this upcoming week. Restrict your selection strictly to assets driven by upcoming earnings, major economic data releases, or significant geopolitical catalysts. For each ticker, break down the specific catalyst and its expected volatility impact, the structural strat setup and the exact timeframes it is manifest on, proximity to key institutional order blocks or open gap fill zones, and any unusual options volume or open interest accumulation. Format this exclusively as a professional trader's pre-market prep sheet. Prompt 2. The daily pre-market flow and momentum scanner plaintext. ACT, as an institutional pre-market analyst, isolate 5 to 10 tickers experiencing significant pre-market price movement driven by overnight headlines or early earnings reactions. For each asset, detail the core catalyst headline, precise pre-market price metrics and volume profile, the existence of clean strat setups on the daily or 4-hour time frames, and whether live options flow shows aggressive call or put bias. Rank the final selection in descending order based on pure momentum potential and structural liquidity. Prompt 3. Options flow and strat breakout screener plaintext. Scan today's live market data and isolate 5 tickers exhibiting a powerful convergence of aggressive options flow paired with an active strat setup. Cross-reference these setups against major daily order blocks and historical gap fills to surface high conviction moves. Include the exact strike prices and expiration dates capturing the highest volume, and specify the exact timeframes of the underlying technical setups. Prompt 4. Actionable macro volatility summary. Plaintext. Summarize the most critical economic indicators, Federal Reserve speaker schedules, corporate earnings reports, and macroeconomic catalysts slated for this week. For each critical item, define the exact day and time of the release, the mathematical expectation of its impact on market volatility, and the specific market sectors or tickers most vulnerable to the data print. Structure this as an actionable risk mitigation brief for options traders. Prompt 5. The Strategic Catalyst Execution Blueprint Plaintext. Analyze the following news headline. Based on this specific catalyst, construct a comprehensive, structural trade plan for a highly liquid asset, e.g., SPY, QQ, NVDA, TSLA, or APO. Check for an active strat setup forming on the daily or 4-hour charts. Determine if current price action is resting within an institutional order block or a gap fill zone. Synthesize this data with live options flow metrics to provide a definitive trade idea complete with a precise technical entry trigger, an invalidation stop, loss, and realistic profit targets. Chapter 3: Characteristics of the Elite Trader. The bridge between retail failure and institutional-grade profitability is not built on secret indicators. It is constructed from psychological and behavioral traits. The market is a mirror that remorselessly exposes every flaw in a person's character. To survive, you must consciously cultivate the specific behavioral disciplines that define the elite market participant. First, dynamic tactical flexibility. An elite trader operates with absolute psychological fluidity. You must remain entirely willing to drop a bias or change an active position the moment live market data or structural trends shift. Emotional attachment to a bias is a terminal diagnosis in professional trading. When you marry a specific thesis, you blind yourself to the reality printed on the tape. The professional trader has no ego. They care about tracking the flow of capital, not about being right. Second, unyielding capital protection. Catastrophic account drawdowns are almost always caused by an emotional attachment to a losing position. When a trader allows pride to override a structural stop, loss, they have abandoned trading and begun gambling. Elite traders respect risk parameters above all else. You must be prepared to cut a failing position cleanly, instantly, and without remorse. Plain text: ego-driven approach, deny the data, hold and hope. Account liquidation. Elite approach: accept the data. Trigger stop, loss, capital preserve. Third, radical mistake accountability. In the market, errors are incredibly expensive lessons. Recognizing, admitting, and documenting when an execution is failing to perform as anticipated is a core prerequisite for growth. Emotional attachment to a position paralyzes your capacity to objectively assess your errors. If a setup invalidates, accept the data, step aside, and audit your execution with clinical detachment. Fourth, neurological reframing via affirmations. The human brain is naturally wired with a negativity bias, which frequently triggers fear and greed during high-stress trading sessions. To neutralize this, elite traders engage in continuous psychological conditioning. Replacing erratic fear-based thought patterns with structured, positive technical affirmations stabilizes the nervous system. This conditioning reinforces discipline and insulates your decision-making from emotional contamination. Fifth, operational detachment and strategic sabbaticals. Constant exposure to blinking numbers, flashing tickers, and sensory overload will systematically degrade your decision-making capacity. Elite traders recognize when cognitive fatigue sets in. Taking calculated breaks away from live market feeds allows your mind to reset, restores your emotional baseline, and provides a broader perspective on macroeconomic trends. Mental clarity is a direct driver of performance. Sixth, the discipline of the ledger. Rigorous trade journaling. If you do not measure your execution, you cannot improve it. Meticulously recording every single trading decision, technical strategy, emotional state, and metric is what separates professionals from hobbyists. A comprehensive journal highlights behavioral patterns, uncovers hidden execution biases, and reveals the mathematical reality of your operational edge. Seventh, mindful grounding and technical meditation. An increasing number of top-tier institutional money managers utilize daily mindfulness and meditation practices. This discipline enhances your acute awareness of rising emotional triggers before they manifest as destructive actions. By observing your thoughts from a detached perspective, you retain the ability to execute decisions based strictly on rational, structural criteria. The executive trading law is the law of absolute compliance. Whether your day concludes in the green or in the red, if you executed your trade plan and followed your systemic rules flawlessly, you operated correctly. A disciplined loss is a professional success. An undisciplined win is a dangerous failure. The law of capital redistribution. The financial markets are a vast mechanism designed to transfer wealth from the impatient to the patient. Never allow yourself to become a pawn for institutional market makers. Do not force low probability setups out of boredom or desperation. If the market is unreadable, protect your capital, protect your peace, and wait for your precise edge to manifest. The myth of the Holy Grail system. There is no flawless indicator, no perfect algorithm, and no magical system in the financial markets. Stop wasting time and capital searching for a mythical shortcut. Instead, focus entirely on mastering an effective, statistically proven system that aligns with your personal risk tolerance. A clean, simple edge makes it vastly easier to enforce. System rules govern emotional impulses and manage capital with surgical precision. Eliminating the illusion of control, you cannot step up to your terminal and dictate when or how much the market will pay you. The market owes you nothing. You must arrive every day with a winner's mentality, entirely detached from specific financial outcomes and deeply focused on flawless execution. When a trade moves against your structure, leave your ego at the door, accept that your thesis was wrong, execute your stop, loss, and reanalyze the tape from an unbiased perspective. The reality of execution timing and intraday expirations, perfect timing, buying the absolute bottom or selling the absolute top of a daily range is a mathematical anomaly. If you happen to catch the exact turning point of a daily trend, it does not mean you have mastered the market. It simply means the structural probabilities align perfectly with your plan at that moment. Chasing a perfect entry will frequently cause you to miss excellent, high probability execution windows. Furthermore, if you are trading leveraged options instruments, specifically 0 days to expiration contracts, you must respect the lethal speed of theta decay. If your profit target is not captured within your anticipated intraday window, theta will aggressively destroy your contract's premium value, even if the underlying asset consolidates sideways. If your core structural thesis requires room to develop, you must purchase additional time to expiration rather than taking unnecessary, extended risks on odd contracts. Give your trade the duration it requires to clear structural noise. Chapter 4: Market Structure and Architectural Mechanics. Market structure is the fundamental foundation of price action trading. It serves as the core framework for every professional technical decision executed across the global markets. To master price action, you must develop an advanced, automated capability to read and interpret this underlying structural matrix. Plain text: bullish structure, bearish structure. The bullish matrix: during an established uptrend, price action constructs a clean architectural pattern of ascending highs and ascending lows. This structural signature indicates an optimistic market regime where demand consistently absorbs supply, projecting a high probability of continued upward expansion. The bearish matrix, conversely, within a structural downtrend, the tape prints a continuous sequence of declining highs and declining lows. This signature denotes a pessimistic market regime dominated by aggressive supply distribution. The core skill, the ultimate key to profitable price action trading, rests in your ability to identify the exact moments when these structural boundaries shift, signaling a definitive regime change from bearish distribution to bullish accumulation. Advanced structural high probability breakout. Components: identification. An authentic structural breakout occurs when an asset's price moves decisively beyond a well-defined technical boundary, accompanied by a sharp expansion in volatility and volume. These moves signal that a market is transitioning out of a balanced range and into a sustained, trending phase. However, you must actively protect yourself against false breakouts. Institutional algorithms routinely drive prices just beyond visible retail levels to trigger stop losses and harvest liquidity before reversing the market. Mitigating this risk requires strict position sizing and the automated deployment of stop-loss orders. To maximize the accuracy of your breakout confirmations, you must cross-reference price action with key volume metrics and auxiliary technical indicators. Structural confirmation rules. Volume validation. A breakout must be validated by a massive surge in relative trading volume. An expansion in volume confirms heavy institutional participation and validates the structural shift. Trendline piercing. When price action cleanly breaks through a multi-touch macro trendline, it signals an immediate threat to the dominant trend regime. The structural retest. Following a clean breakout, price will frequently pull back to retest the broken structural boundary, turning previous resistance into new support, or vice versa. A low volume successful retest provides an exceptional, low-risk entry trigger. Second, price channel dynamics. A price channel is an architectural asset boundary map by drawing two perfectly parallel trend lines that encapsulate price action over a specific duration. The upper parallel boundary represents supply, while the lower boundary represents demand. The space isolated between these lines defines the channel, marking a clear range. Our market regime. Trading within a channel requires customized strategies tailored to your specific risk parameters. When planned with precision, channel frameworks offer highly predictable boundaries for executing entries and managing exits. Plain text. Upper channel boundary. Price waves. Lower channel boundary. Enter long, exit shorts. Regime alignment. Price channels demonstrate their highest statistical reliability within clear trending environments. Sideways or hyper, choppy markets degrade channel clean lines. Confluence indicators. Never rely on a price channel in isolation. Always validate channel boundaries using momentum oscillators and key moving averages. Timeframe synthesis. Analyze multiple timeframes simultaneously. A lower timeframe channel boundary that aligns with a major daily or weekly support level carries institutional weight. Surgical exit mapping. Enforce systematic profit-taking protocols. Liquidate long positions precisely as price approaches the upper parallel resistance line. Liquidate short positions as price tags the lower parallel support boundary. Third, volume profile analysis. Trading volume represents the aggregate quantity of shares or contracts executed within a specific time frame. It is the literal footprint of institutional capital. Volume analysis allows a trader to determine if a specific price movement is driven by authentic institutional conviction or minor retail speculation. Price, volume, momentum alignment. Look for clean structural alignment between volume trends and price development. An expanding volume profile, paired with rising prices, confirms a healthy, aggressive uptrend. Conversely, expanding volume paired with falling prices signals heavy institutional distribution. Indicator confluence. Always synthesize your volume analysis with underlying fundamental catalysts and higher-level technical structures to form a comprehensive, multi-layered execution plan. Climactic volume reversals. A sudden, parabolic spike in volume following an extended trend frequently signals an exhaustion event. This structural anomaly indicates that a trend is hitting a major reversal point. Fourth, the hammer candlestick architecture. The hammer is a critical single candle reversal pattern that materializes when an asset opens, experiences an aggressive intra-candle sell off, and subsequently staging a powerful rally to close near its opening print. Plaintext. Real body LL lower shadow wick. This structural architecture reflects a complete intra-candle shift in power. Sellers dominated early, but buyers stepped in with sufficient force to completely absorb the supply and drive price back up. While hammers form across all time frames, a hammer is never an immediate buy signal on its own. It represents potential value and strictly requires validation from the subsequent candle print before any capital can be deployed. Fifth, the death cross phenomenon. The death cross is a trailing macro technical pattern that signals long-term price weakness. It manifests on a chart when a shorter-term moving average, specifically the 50-day simple moving average, crosses directly below a long-term trend indicator, typically the 200-day SMA. Despite its ominous name, the pattern is a lagging indicator that reflects historical data. Institutional backtests reveal that by the time a death cross prints, the market is often deeply oversold in the short term, frequently setting up a brief counter-trend recovery that yields above average returns before the long-term bearish trend resumes. Sentiment shift. The crossover confirms that selling pressure has remained intense enough to break long-term institutional support levels, shifting the macro sentiment to bearish. Risk mitigation boundaries. Professional short sellers frequently utilize the price zone of the active death cross or the descending 200-day SMA as a major structural line of resistance for placing macro stop-loss orders. Resistance solidification. Once the crossover is officially confirmed, the 200 days SMA transitions into a primary overhead resistance level for all subsequent medium-term relief rallies. 6. Technical pullback mechanics. A pullback is a temporary counter-trend retracement or brief consolidation period that occurs within an active, healthy uptrend. It represents a vital moment of rebalancing before the primary trend resumes. Plain text. Uptrend extension. Healthy pullback, retest of support. Trend resumption pullbacks regularly materialize when an asset's price slides back to a verified technical support zone such as a key moving average, a historical pivot point, an institutional order block, or a key Fibonacci retracement ratio before finding buyers. You must monitor these support zones with extreme care. If price action breaks below these levels on expanding volume, the move is no longer a healthy pullback, it is a structural trend reversal. Confluence isolation, pinpoint exact zones where horizontal support intersects with a rising moving average, or an open gap. These intersections mark highest probability entry points. The discipline of patience, never initiate a position the moment an asset begins to pull back. Wait for price action to confirm that the retracement is concluding. Look for a bullish reversal candle pattern or a shift in momentum on the lower time frames. Volume decelerations. Healthy pullbacks are structurally characterized by a significant drop in volume. Lower volume during a dip confirms a lack of institutional conviction behind the selling. If volume expands aggressively on a drop, step aside. The cardinal rule of chasing: stop chasing parabolic green candles. Chasing overextended moves forces you to take poor entries with terrible risk toward parameters. Always exercise ultimate patience and wait for a clean, low-volume technical pullback to a verified demand zone. 7th, trailing stop. Loss optimization. A trailing stop loss is an advanced risk management tool where the execution trigger is not fixed at a static dollar amount. Instead, it is set as a specific percentage or dollar variance below the current market price, automatically tracking price action as it climbs. When the asset rises, the trailing stop climbs in perfect lockstep. However, when the asset stops gaining and consolidates, the trailing stop locks firmly in place at its highest attained level. If price action reverses and hits that lock point, the position is automatically liquidated. This mechanism protects your capital and locks in paper profits while giving the trade room to run unrestricted. The market maker risk. You must realize that institutional market makers and high-frequency algorithms are highly aware of visible retail stop clusters. They will routinely manipulate price action on lower time frames to trigger those stops, sweeping the liquidity before driving the market back in the original direction. The proximity error. If you configure your trailing stop too tightly to early intraday support structures, minor market noise will prematurely trigger your stop. This results in getting chopped out of a winning trade before the core move ever materializes. A frustrating emotional error. Give your trailing stops appropriate structural breathing room based on the asset's average true range. 8th, the laws of supply and demand. The structural movement of price action is governed by the core economic laws of supply and demand. When demand outpaces available supply, prices climb. When supply floods the market and demand dries up, prices collapse. Plaintext: demand outpaces supply, prices rise, incentivizes production profit taking. Supply outpaces demand, prices fall, incentivizes consumption capital accumulation. Zone inversion. When an asset repeatedly tests an established supply zone and sellers fail to defend the level, that specific price range flips into a demand zone, allowing buyers to assume complete structural control. The compression rule. The narrower and tighter supply or demand consolidation zone is before experiencing an aggressive breakout, the more explosive the subsequent move will be when price eventually retests that zone. Wick invalidation. An authentic institutional supply zone typically exhibits clean, rapid price rejections. If a zone is plagued by excessive, messy candlestick wicks and prolonged sideways chop, that supply zone is invalid for future trading. 9th, the head and shoulders architecture. The head and shoulders pattern is a highly reliable macro reversal structure that signals the transition from a bullish trend to a bearish distribution phase. The architecture consists of a baseline supporting 3 distinct peaks, a left shoulder, a higher central peak, and a final lower peak. Plaintext. Confirmation trigger. The trapped liquidity engine as price breaks down through the neckline. Every retail participant who purchased the asset during the rally of the right shoulder or the peak of the head finds themselves trapped in a losing position. Their forced capitulation and market sell orders provide the raw downside momentum that drives the asset toward its technical profit target. Formation discipline. Never anticipate the pattern. Exercise absolute patience and wait for the entire structure to complete and break the neckline before deploying capital. Asymmetry realities. Rare is the chart that prints a visually perfect, symmetrical pattern. Expect irregularities, tilted necklines, and uneven shoulder heights. 10th, the Relative Strength Index mechanics. The Relative Strength Index is a powerful momentum oscillator that measures the speed and velocity of price movements on a scale from 0 to 100. Traditionally, readings above 70 indicate an overbought condition, while readings below 30 point to an oversold environment. Trending regime strategies. A classic retail error is assuming that an overbought RSI means you should immediately short the asset. In a strong institutional trend, an asset can remain overbought for weeks. An elite strategy for an uptrend is waiting for the RSI to become overbought to confirm momentum, and then executing a long position the moment the RSI pulls back and holds above the 50 midline. Divergence identification. Look for structural divergences between price action and the RSI line. If price prints a higher high but the RSI prints a lower high, you are witnessing a bearish divergence, a strong warning that momentum is completely fading and a reversal is imminent. 11th, the double bottom structure. The double bottom is a classic technical pattern that signals a major trend reversal from a bearish markdown phase to a bullish accumulation phase. It forms a distinct W shape on the chart and marks a line of strong structural support. Plain text. Price markdown, first bottom, technical bounce, second bottom, neckline breakout. The first bottom, price hits an extended low, becomes temporarily oversold, and experiences a brief upward correction. This bounce is simply a minor relief rally within the broader downtrend. The second bottom, the asset drops back down to retest the previous low. Heavy institutional buying enters the market, completely absorbing the selling pressure and forming the second floor. The neckline validation. The double bottom structure is officially completed and validated only when price action drives cleanly through the horizontal resistance peak formed by the intermediate bounce. This breakout confirms that buyers have taken total control of the tape. 12th, the harmonic ABCD architecture. The ABCD pattern is a foundational harmonic structure that utilizes precise Fibonacci ratios to map repetitive market waves and identify high probability reversal points. Plain text. B, zone D, the AB leg. The initial, sharp directional price movement from point A to point B. The BC leg, a low, volume, counter, trend retracement that runs from point B to point C. Structurally, this retracement must hit a specific Fibonacci level, typically the 38.2% or 61.8% retracement of the original AB leg. The CD leg, price reverses course at point C and moves back in the direction of the primary AB wave. Mathematically, the CD leg is expected to mirror the exact price distance and time duration of the AB leg. The D reversal zone, point D, marks the termination of the pattern and represents a high probability reversal zone. Elite traders do not blindly buy point D. They wait for candlestick validation or RSI. The cycle of market emotions, divergence to confirm the entry, market realities versus retail myths. Chapter 5, designing and executing the trade plan. An elite trader never logs onto a terminal to see what happens. Every single market interaction must be governed by a predetermined, written, and mathematically sound trade plan. If you are guessing, you are gambling. The 5 operational pillars of a trade plan. Market conditions. You must identify the current macroeconomic environment and market regime. Is the index choppy, range bound, or clearly trending? Time frame alignment. You must isolate the specific time frames that dictate your trade. If your core setup is based on the daily chart, do not allow a 1-minute wiggle to shake you out of your position. Strategic targets and stop losses, your profit targets, and risk and validation points must be mapped out before you execute the trade. Position size management. Your risk per trade must be a fixed, calculated percentage of your total capital. Never arbitrary, never oversized. Intra-trade management. Define exactly how you will manage the position once it is live. Will you scale out at T partial targets or trail your stop? The trader's mindset. Blueprint. Enforce your plan. Trust your engineered process. Disconnect your emotions entirely and let the raw geometry of the chart dictate your execution. Patience plus strategy equal to systemic gratification. Developing your strategic vehicle. Scalps versus trend trades. Before entering any position, you must define the exact technical vehicle you are deploying. Blurring the lines between A, Scalping a trend trade is a classic path to retail failure. The scalp execution model. Objective: capitalizing on minor, highly rapid intraday price dislocations. Duration: minutes, sometimes seconds. Execution: lightning, fast entries paired with immediate market limit exits. Management requires extreme focus and tight risk controls. If the momentum stalls, liquidate immediately. The trend trade execution model. Objective: capitalizing on larger daily range expansions and macro waves. Duration: several hours across the trading session. Execution: calculated entries on verified pullbacks or major structural breakouts. Management requires patience. You must ignore minor lower time frame counter movements and allow the larger trend to develop. Systemic exit protocols. There are strictly two ways a professional position is ever concluded. 1. Your technical profit target is captured. 2. Your structural stop loss is triggered. Everything else that occurs in between those two levels is meaningless noise. Pullbacks, brief consolidations, and minor counter trend bounces are standard components of healthy price discovery. If minor price wiggles cause you to panic, you are focusing too much on the money and allowing your emotions to override your technical edge. Chart architecture. Setting up your daily workstation prior to the opening bell, you must explicitly mark out these 4 critical institutional levels. On your 5-minute and 15-minute execution charts, plain text, major resistance area, institutional breakout level, live price action, a level institutional breakdown, 1 major support area, eradicating the fear of financial loss. Operating out of a state of fear means your mind is entirely paralyzed by risk, making it statistically impossible for you to hold a winning trade to its full reward potential. To permanently eliminate execution fear, you must adopt 4 structural shifts. Deploy a documented edge. Only trade strategies that have been proven to generate a positive mathematical expectancy over a large sample size of trades. Eliminate guessing. Eradicate all ego-driven predictions from your terminal. Trust the raw data on the tape over what you think should happen. Accept loss as a business cost. Reframe your relationship with losing. In active trading, a loss is not a personal failure. It is simply a standard cost of doing business, identical to paying rent for a retail shop. You must lose trades in order to win long term. Enforce asymmetric risk toward ratios. Maintain a strict 3:1 risk to reward ratio across your setups. When your targets are 3 times larger than your stop losses, you can lose 60% of your trades and still remain highly profitable over time. Plain text. 3:1 asymmetry plus equal to net profit plus $300 position sizing. Asymmetry laws. The size of your position must directly dictate the structural parameters of your risk management. Larger position size, tighter technical stop loss, smaller position size equal to wider structural stop loss. The executive playbook for active intraday trading. Align with momentum. The trend is your definitive vehicle. Trade in perfect alignment with the dominant institutional momentum of the day. The chop liquidation rule. Focus entirely on your setup. If price action devolves into highly volatile, directionless chop, exit the trade immediately. You can always enter the position at a cleaner price once structure reorganizes. Ride the strong volume waves. Only ride the expansions of strong high-volume candles on the 5-minute time frame. 91. Filter for high probability confluences. Restrict your capital strictly to setups backed by robust fundamental catalysts. Strong relative volume, heavy market capitalization, and undeniable institutional order flow. The overextension mean aversion rules. Assets that become deeply oversold at historical 2. Weak support lines demonstrate a strong statistical probability to rally. Conversely, assets that become heavily overbought at major multi-day resistance zones are highly prone to pull back. Acknowledge sector rotation. Adapt instantly to shifting capital flows. Every 2 to 3 days, institutional capital rotates into a new sector while cooling down previous high flyers. Follow the cash flow. Psychological inventory check. Before you place a single trade, ask yourself honestly, is my current mental and emotional state optimal to risk capital right now? If the answer is no, stay flat. Institutional execution tactics for extreme closing volatility. Navigate the kangaroo market. You cannot control market outcomes. Always trade the raw structural reality printed on the screen. Never trade what you think or hope will happen. Process-oriented focus. Train your mind to focus entirely on the flawless execution of your trading process, remaining completely detached from the monetary outcomes of individual trades. Every outcome is an independent, random variable. The sniper paradigm. Be a patient market sniper, not a chaotic machine gunner. Sit on your hands, observe the market layout, and deploy. Capital only when a textbook setup enters your sights. The last 15 closing edge on a highly directional trading day where the SPY has moved 4 points or more from its absolute lotto high and has entered a late afternoon consolidation range. Analyze the SPX options chain. Look to purchase SPX contracts that were trading above 15.0 AT, their highest point of the day, but have decayed down to 50 into the final 15 minutes of the session. These contracts are price AT true value and capture massive institutional volume into the closing cross. The 10-minute rig close order strategy, AT exactly 3:50 p.m. EST, during the highly volatile algorithmic closing cross. Set a limit buy order placed strictly at what the highest technical resistance is worth on the put chain, while simultaneously setting a limit buy order at what the lowest technical support is worth on the SPX call chain. Analyze the tape from both sides and let the closing volume fill your entries at deep discounts. The imperative closing hedge rules. If you are holding an active SPX or SPY options contract heading into the final 15 minutes of the market close, you must establish an explicit hedge to insulate your capital against a sudden closing flush or squeeze. The closing hedge playbook. If you are holding a 4,490 put contract worth 500 into the final 15 minutes of the session, immediately purchase a protective 4,485 call contract for 30. If an algorithmic squeeze drives your put completely out of the money, your hyper-leveraged hedge call option will explode in value, recovering your 500 risk outlay and preserving your daily balance. Enforce automated sell limits. Utilizing pre-stage sell limit orders eliminates operational hesitation and locks in your targets before institutional algorithms reverse the market. The gap continuation law. The larger the opening gap is on the daily chart, the higher the statistical probability that the price action will continue driving aggressively in that specific direction for the remainder of the session. The single touch target law. When you are managing an options position and price hits your technical target for the first time, liquidate your contracts immediately. Do not expect the asset to return to that exact peak premium price after a technical pullback. Quite often, it will consolidate near the high but never match that initial premium spike due to rapid intraday theta decay. The partial technical recovery protocol. If you execute an entry and the trade moves out of the money, monitor the contract premium closely. If the contract premium has plummeted from an entry of 10 down to 3, but then recovers back to 6 on a technical bounce, exit the position immediately. Accept the partial loss and step aside. Do not hope for a full recovery to break even. Patience-driven selection. Cultivate the extreme discipline required to execute only 1 or 2 pristine, high-conviction trades per week. Waiting exclusively for the highest probability setups pays out significantly more than trading daily noise. To effectively demonstrate the lethal speed of time decay discussed in your chapters, especially regarding 0 days to expiration contracts, your digital book needs an interactive simulator. Below is the conceptual framework of the option decay curve, followed by the deployable interactive widget. The mechanics of linear versus parabolic decay in standard options contracts with weeks or months left until expiration. Time decay operates on a square root curve, accelerating gently as expiration approaches. However, for an AT contract, the macro timeline is compressed into a single 6.5-hour trading session. Within this intraday window, the decay profile shifts dramatically based on whether the contract is out of the money or at the money. OTM contracts/TOM options possess 0 intrinsic value. They are composed entirely of extrinsic value. As the closing bell approaches, the probability of the option landing in the money plummets towards 0. Consequently, its decay curve is heavily front-loaded and parabolically steepens through the afternoon. ATM contracts, ATM options hold the maximum amount of extrinsic value because their outcome is the most uncertain. They decay at a relatively steady linear rate throughout the morning, but experience an absolute collapse in the final 60 minutes of the session as uncertainty is violently resolved to either O or intrinsic value. Interactive intraday odd option decay simulator widget allows your readers manipulate the starting. This to premium, choose between an athlete, money or out of the money profile, and observe exactly how the contract value systematically erodes minute by minute across the trading day if the underlying stock price remains completely flat. To complement the position sizing laws established in your trade plan chapters, your digital edition requires a tool that eliminates manual calculation errors during high-stress market moments. As a professional day trader, your position sizing must never be an arbitrary guess or based on the dollar amount of your option contract. It must be a direct mathematical output derived from account balance, portfolio risk tolerance percentage, and your technical stop, loss and validation point. The math behind institutional position sizing. When trading options, especially volatile vehicles like SPY or SPX, you should size your trade using a fixed risk protocol rather than just guessing how many contracts to buy. The fundamental formula is maximum dollar risk, account balance number of contracts equal to stop loss value per contract maximum dollar risk. For example, if you risk 1% of a $50,000 account and your stop loss on an SPX contract is $1.25 per contract, your maximum sizing is exactly 4 contracts. If the trade hits your target at a 3-1 ratio, you return $1,500 while risking only $500. Interactive risk to reward and position sizing calculator. This responsive widget enables your readers to input their current account balance, define their exact risk parameters per trade, choose their execution vehicle, and immediately calculate their precise position size alongside an asymmetric risk toward metrics display. Container inner HTML equal to institutional position sizer and R engine calculate asymmetric position distribution based on strict capital preservation laws. These 2 chapters read like a masterclass in market survival. It's clear this playbook was written in the trenches, forged through the pain of taking major losses, letting hope dictate execution, and learning the hard way that the market doesn't care about opinions. To help you internalize, memorize, and mechanically apply these rules every single morning, here is a highly scannable, structural distillation of your trading manifesto. 1. The core directives. The casino mindset. Become the casino instead of the gambler. Casinos accept random short-term outcomes because they know their math guarantees a 1.7% daily edge. You do not need to know what happens next to make money. Risk management boundaries. Account sizing. Never risk more than 5% of your total account balance on a single trade. The 20% rule. If a trade goes 20% against you, it is an automatic, emotionless cut. No trailing, no hoping, no adding to a loser. Take profit targets. Lock in standard gains at 15% to 20%. It is infinitely better to take a 10% gain than an 80% loss. Runners. If conviction is sky high, take profit at targets resistance, make the remaining contracts free, and let the rest run to the next key level. Friday and OT laws. The 30-minute open trap. On Fridays, market makers typically run the market up for the first 30 minutes to destroy put premiums and trap bulls. Do not chase the morning open. The 3 p.m. dead zone. Everything after 3 p.m. on a Friday is mostly worthless due to decay. If you are up 250% to 300% on a Friday, take your profit instantly. The out of the money rule. If an option goes up 120% but remains OTM on a Friday, sell it immediately before the fast end of day reversal wipes it to zero. Never hold an OTM contract into the close. 2. Technical checklists and market rules. Before clicking buy or sell, you must secure 4 to 5 positive confirmations across these criteria. Trend determination hierarchy. 1. Weekly chart. Establish the long-term macro trend. 2. Daily/4 hour chart. Determine the current structural swing. 3. 15-minute, 5-minute chart. Identify intraday momentum and look left for key levels. 4. 1-minute chart. Reserved strictly for fast scalp execution. Indicator matrix. The look left level protocol always explicitly mark and watch these micro and macro structures. Pre-market high and pre-market low. Yesterday's high end. The opening print price. Psychological whole numbers. Yesterday's low. Fibonacci retracement channels. Always check AT. Least 2 levels for confluence. 3. The rules of engagement procedure when a setup begins to form. Execute your entries and exits using this exact chronological sequence. 1. Analyze context and catalyst pre-market. Ensure the ticker has a real news or macro catalyst driving it. Check Google Trends, bar chart volume leaders, and Bitcoin's relative strength for market sentiment clues. If it isn't a high volume leader, do not trade it. 2. Verify the base and confirmations market open. Let the initial 15 to 30 minutes settle. Wait for candlesticks to establish a base over or under V double up and hold after retesting the wicks. Accumulate your 4 to 5 points of technical confirmation. Deploy the test our position entry phase 1. Never deploy full capital instantly. Set a limit order to enter with 1 contract based on the super trend indicator to gauge real-time momentum. 4. Tier into full size entry phase 2. Once the CCI trend confirms your direction and volume inflows validate the move, tier scale into your planned position size. Immediately set your hard stop loss. 5. Execute mechanical exit phase. Sell automatically when price hits your predetermined target or when the very first red opposite color candle prints a key resistance. If the trade breaks, support instead. Cut it back to break even or a max 20% loss. 4. The psychological reset affirmations. Read these daily before the opening bell to align your mind with neutral market data. No bias. I have no commitment to a specific outcome. Every single day is completely unique. I do not predict. I purely react to the chart lines, not the headlines. No trigger, no trade. Sometimes doing absolutely nothing and waiting for a pristine setup is the most profitable move of the week. The ultimate promise, holding and hoping, is stupid. If the trend fails and breaks support, I will exit the position ASAP. I will not lose. More hard, earn money. To make these rules completely muscle memory, focus on mastering just one single stock or ETF over the next 2 weeks. Take a notebook and track your thoughts, emotions, and actions as the days progress. Use it to spot exactly where greed tries to compromise your risk management. The raw data, fractured notes, and hard-earned realizations from your trading log have been transformed into definitive, institutional, grade prose. The structure preserves your voice while introducing high-end formatting to maximize clarity, scannability, and structural impact. On the daily chart, if SPY is above the 20-day moving average, buy the LAST 10 minutes AT close. And if below the 20-day MA, short the LAST 10 minutes into close or LAST 5 minutes. Example, SPY sold down to 632. Look for rally to 634.35 and take profit. Chapter 6, Systemic Execution, Setting and Enforcing the Laws of the Tape. The ultimate objective of a professional trading framework is the absolute preservation of capital first, and the systematic expansion of the account balance second, strictly in that sequence. The retail market participant operates on opinion, bias, and hope. The institutional grade market operator functions exclusively on quantifiable facts, mathematical probabilities, and rigid execution architecture. Plain text. The capital mandate: 1. Preserve account balance. 2. Grow account balance. To bridge this gap, you must transition from a discretionary gambler to a mechanical operator by integrating these 16 immutable laws into your daily execution workflow. The 16 laws of mechanical trading. Asymmetric expectancy. Your execution system must be engineered to deliver a mathematical edge characterized by large, structural wins and tiny, tightly contained losses. Never assume an equal dollar risk. 2. Reward ratio. If a setup cannot fundamentally yield an asymmetric payoff, it must be passed over. Second, quantitative fact factoring. Banish opinions, talking heads, and social media echo chambers from your terminal. Your system must be built entirely on objective, quantifiable data points, volume profiles, historical liquidity pools, and clear structural footprints. Trade the chart lines, never the headlines. Third, structural probability filters. Only allocate capital to setups that display a high statistical probability of success paired with a clearly defined, low risk invalidation level. If the risk profile cannot be definitively measured prior to entry, the trade does not exist. Fourth time frame contextualization. The question, what is the trend, is completely meaningless without answering the underlying question, on what time frame. A chart can be intensely bearish on a 5-minute matrix while printing a macro bullish continuation on a 4-hour structural arc. You must define your operational duration before deploying capital. Fifth, top-down macro analysis. Always initiate your charting routine on the weekly time frame to map out the primary long-term trend and institutional liquidity zones. Progress systematically down to the daily, 4-hour, and hourly charts to identify execution entry points. The mathematical odds of a trade success scale exponentially when your intraday execution aligns with the primary macro trend. Plain text, macro alignment engine, equal to high probability wins. Sixth, resistance, support decay mechanics. The more frequently a horizontal support or resistance level is tested by price action, the weaker that boundary becomes and the higher the statistical probability that it will violently break. Typically, a level will fail on its third or fourth test. Once breached, an inversion occurs. Historical resistance converts into new support, and old support solidifies into new resistance. Seventh, moving average quantization. Utilize moving averages not as magic prediction lines, but to mathematically quantify trend velocity and establish objective, systematic signals for entry triggers, risk invalidations, and trailing stops. Eighth, the law of market extremes. In a confirmed macro bull market, overhead historical resistance lines are highly vulnerable to being continuously shattered. There is no permanent ceiling. Conversely, in a structural bear market, underlying support levels offer no long-term protection against distribution. Do not attempt to step in front of institutional trains. Ninth, the law of volatility gaps. The wider a morning opening gap is on a daily chart, the greater the statistical probability of an aggressive continuation in the direction of that gap. Large gaps indicate severe overnight order flow imbalances that require sustained intraday expansion to find equilibrium. 10th, the final hour truth protocol. The final 60 minutes of the trading session reveals the true conviction of institutional smart money. Retail traders dominate the opening bell with erratic, emotional orders. Institutional algorithms take control into the close to trap over leveraged shorts or exhausted longs. Consecutive strong closes project a high probability of next day continuation. However, a massive morning rally that reverses into a weak, flushing close signals that the uptrend is entering immediate structural exhaustion. 11th, the 200-day moving average line of demarcation. The 200-day simple moving average serves as the definitive boundary for structural market sentiment. Price action trading above the 200-day SMA is a fundamentally bullish environment where pullbacks are to be bought. Conversely, price action sustained below the 200-day SMA is a structurally bearish environment where relief rallies must be shorted. Plain text, a bullish regime, or 200-day simple moving average, v bearish regime. 12th, asset specialization focus. It is infinitely more profitable to deeply master the structural nuances, liquidity pools, and algorithmic behaviors of 1 to 3 highly liquid tickers than to blindly track a chaotic scanner of 50 stocks. Specialization builds intuitive pattern recognition. 13th, the exhaustion wave law. The initial, sharp, rapid dip within a mature uptrend will almost always find aggressive, reactive buyers. Conversely, the initial parabolic surge within an established downtrend will consistently attract aggressive institutional sellers. Reversals are architectural processes. Macro tops and bottoms build slowly through distribution and accumulation. They rarely happen on a single candle. 14th, behavioral second nature. Successful trading requires executing the psychologically difficult task so consistently that it transitions into an automated, subconscious reflex. Cutting losses instantly and sitting on your hands out of boredom must become second nature. 15th, immediate alpha confirmation. The absolute best technical setups will almost always move deeply into profit immediately following execution. When your chart geometry and risk parameters are mapped accurately, the market will rapidly reward your entries with an immediate influx of volume. If a position stalls, chops, and battles your entry price for extended periods, your structural thesis is likely flawed. 16th, banishment of the hope illusion. Wishful thinking must be violently banished from your trading desk. Hope is not an operational framework, it is not a technical indicator, and it is a guaranteed strategy for account liquidation. If the chart breaks support, your position is dead. Liquidated instantly. Intra-session tactical adjustments. The 3-day left rule. Before entering an intraday position, analyze the previous 3 days of chart action across the pre-market and after-hour sessions to map out hidden liquidity blocks, value areas, and structural pivots. The 3-day momentum exhaustion law. If a highly liquid asset experiences a massive vertical expansion for 2 consecutive sessions, it will show an elevated statistical probability to stall, reverse, or experience a heavy profit, taking flush on the 3rd day. Lock in gains on day 2 and wait for the pullback. Options premium reality checks into the market close. Market makers heavily overcharge for near the money odd options contracts. For example, if SPX is trading a T4108 with 15 minutes left until the bell, and market makers are demanding $3.50 for the out of the 4110 call, that option is structurally overpriced relative to its mathematical probability of expiring in the. Conversely, if SPX is a T4180 and the 4100 deep in the call is trading at $2.40, it is pricing in zero extrinsic value. Track the premium pricing. It reveals the market maker's actual risk exposure. The 1-to-3 intraday premium ratio on a standard, non-trending range day, an option. Contracts premium will frequently fluctuate between its low of day and high of day in a highly predictable 1-to-3 mathematical ratio. If an option finds a structural floor at a $1 premium, it will highly likely top out near a $3 premium before experiencing severe theta decay and value retraction. When is the best time to trade? 3/000 to 4:000 p.m. E-power hour when market closes until it to increase. Structural asset parameters to filter out highly manipulated, illiquid traps. You must run every ticker through the flow to capitalization matrix before deploying capital. The multi-contract scaling directive. When executing highly volatile setups, adopt a multi-contract tiering protocol. Initiate the trade with a single contract to verify immediate alignment with indicators like the super trend. The moment secondary indicators confirm a sustained breakout, scale in additional contracts. If the position is an intraday early morning scalp, never hold the position for more than 5 to 15 minutes if it shows signs of momentum stagnation. Take your profits cleanly, step aside, and re-enter at a more favorable, lower risk strike price if the macro setup confirms. Chapter 7: The Sovereign Psychological Mindset. Aim tip. The financial market is a completely unstructured, unlimited environment. It possesses no inherent boundaries, no rules of self-restraint, and no safety rails. To survive and extract capital from this landscape, you must construct your own internal psychological structure. Trading performance is directly driven by your ability to manage your mind, regulate your nervous system, and operate completely in the present moment. Plaintext. The core loop, fear, greed, align. Interpretation, emotional, stability, flawless execution. The 11 pillars of psychological self-mastery. 1. Isolate your technical strengths. Define your specific edge with absolute clarity. Know exactly what setups you have a statistical advantage executing, and ignore everything else. 2. Cultivate process-based confidence. True execution confidence cannot be derived from financial outcomes. It must be built on your proven ability to follow your rules flawlessly, regardless of whether an individual trade wins or loses. 3. Document and contain your weaknesses. Identify your primary behavioral blind spots and design mechanical roadblocks to prevent them from damaging your capital. 4. Enforce strategic rest cycles. When your emotional baseline is compromised by a large loss or cognitive fatigue, you must completely remove yourself from the screens. Mental clarity is a direct driver of alpha. 5. Achieve radical self-awareness. Monitor your physical and emotional states in real time during market hours. If you detect an elevated heart rate, shallow breathing, or rising anxiety, your higher executive mind is being hijacked by fear. 6. Maintain extreme adaptability. The market environment shifts continuously. You must retain the psychological fluidity to change your stance the instant the tape prints a trend reversal. 7. Govern your trading environment. Eradicate all external noise, distractions, news feeds, and chat room opinions from your trading workstation. 8. Neutralize cognitive stress. Reframe market volatility not as a threat to your capital, but as neutral data points of price discovery. High volatility requires immediate emotional de-escalation. 9. Pinpoint emotional triggers. Keep an active journal tracking your internal state. Isolate the exact moments when greed or fear begins to compromise your technical planning. 10. Establish a rigid morning routine. To achieve optimal mindfulness, you must secure a proper night's rest, meditate to clear mental clutter, and review your macro levels prior to the opening bell. 11. Challenge your ideals regularly. Continuously audit your performance metrics against your stated rules. Strip away any strategies that do not show a clear mathematical advantage. The 3 development modes of trading. Every elite market participant must progress through 3 distinct operational phases to achieve mastery. Phase 1. The mechanical stage, the foundational area where rigid, binary criteria define your trading edge. All execution decisions, entry triggers, position size, and risk parameters are determined entirely in advance of market activity. The market either strictly conforms to your written framework or it does not. There is zero room for personal judgment, guessing, or intuition. Phase 2, the subjective stage. A broader, highly flexible operational mode where you integrate everything you have learned regarding the structural nature of price movement. You use multi-time frame context, market regime adjustments, and relative volume profiles to determine your edge with greater nuance. Phase 3, the intuitive stage, the absolute pinnacle of market mastery. Through thousands of hours of screen time, your brain has mapped out complex visual patterns in order, flow dynamics. You find yourself completely in the zone, perfectly synchronized with the collective consciousness of the market flow. Execution becomes completely mechanical, fluid, and instinctual. The anatomy of greed. A self-diagnostic framework. Greed is an emotional state where financial ambition completely compromises your logical decision-making. It ignores all structural risk parameters in a reckless pursuit of unearned profits, trapping the trader in a fantasy land of imagined gains. To resolve systemic greed, you must meticulously document your behavior across 6 specific operational dimensions over a 2-week period. Plaintext. Read audit metrics. At the conclusion of every session, assign a definitive severity score from 1 to 10 to each dimension. Isolate the core driving factor behind your greed, whether it is a desire to get rich quick or an urge to make up for a past loss, and implement immediate mechanical restrictions to eliminate it. The Principles of Consistency Manifesto. Principle 1. I define my edge with absolute, objective clarity. Principle 2. I predefine the precise risk of every single trade prior to execution. Principle 3. I completely accept the risk of the trade, or I will let the setup go without regret. Princitation 4. I act on my edge instantly, without a shred of hesitation or reservation. Principle 5. I pay myself mechanically as the market makes capital available to me. Principle 6. I continuously monitor my personal susceptibilities to execution errors. Principle 7. I deeply understand these laws of consistency, and I will never violate them. Chapter 8. Advanced Risk Management and Capital Allocation Mechanics. In a completely random market environment where anything can happen at any given moment, defensive risk management is your only protection against total financial liquidation. Professional trading is not a game of predicting where an asset will go. It is a business of managing uncertainty, controlling position exposure, and trading mathematical statistics. Plain text: the trader's core function: manage uncertainty, control exposure. Scale statistics, institutional execution guidelines. The tactical entry filter: every single position you enter must be backed by a clear analytical plan detailing 3 key structural confirmation points: a verified volume inflow, an active chart set up at a significant level of interest, and an explicit hedge or invalidation stop loss. If you cannot write down these 3 points before clicking the mouse, the trade cannot be taken. No trigger, no trade. Second, defensive capital management: restrict your total cash layout per trade strictly to 5% of your available cash value. Treat your account balance with extreme defensive reverence. You cannot capture, hide, probability macro trends if your capital has been wiped out by reckless over-leveraging on poor setups. Third, intraday support resistance mapping prior to the open. Plot your primary structural lines, pre-market high-low, previous day high-low, and the volume profile point of control. If price breaks above the pre-market high and yesterday's high simultaneously, the momentum is undeniably bullish. Look for long confirmations. If price breaks below the pre-market low and yesterday's low, the market is severely bearish. Be focused exclusively on short setups. Fourth, option selection and structuring. When trading directional setups, choose your options contracts wisely to protect against the destructive effects of theta decay and implied volatility crush. Plain text. VIX environment mapping. Low VIX, cheap extrinsic. Value. Deploy iron condors, iron butterflies. High VIX, expensive. Volatility. Sell premium credit spreads by deep item. The money requirement. To mitigate the parabolic time decay of OTM options, prioritize purchasing deep ITM contracts or dating your expirations 2 to 3 weeks out. Deep ITM contracts carry a higher delta and retain strong intrinsic value, insulation your capital against minor pullbacks. The 6. Strike ITM filter. For high velocity intraday trading, count exactly 6 strikes in the money from the previous closing price. Wait patiently for morning premium volatility to subside before entering your pre-calculated entry price limit. The AUD threshold. If you choose to trade high, risk SPX or SPY options into the final 10 to 15 minutes of the session, ensure you are buying contracts that possess the high of day premium value of over $5,000. Never deploy capital into contracts whose maximum premium value peaked at under $2,000 on the session. These contracts lack institutional liquidity and are mathematical certainties to expire worthless. The reality of market anomalies. You must accept that trading exists in an environment governed complex macroeconomic by variables. Occasionally, a fundamentally perfect trade will result in an immediate financial loss due to unexpected market reactions, commonly referred to as buy the rumor, sell the news. Plain text. For example, a company may post record earnings but experience an immediate 15% collapse in its stock price because its forward guidance was slightly soft, or because institutional players utilized a positive retail headline to fill massive sell orders. Pay attention to the daily chart. It tracks the actual flow of money and will reveal the true structural story as it unfolds. When retail sentiment is over bullish, look for institutional distribution structures to position yourself short. Why the 90% of retail traders fail. The path to retail liquidation is heavily documented. To protect your capital, you must actively reverse the 6 behaviors that guarantee failure. Plain text. The retail failure loop, holy grail search, no written plan, emotional over-sizing, indicator overload, providing liquidity to smart money. 1. Searching for the holy grail, wasting years looking for a flawless indicator or magical algorithm that never loses, instead of mastering a simple statistical edge. 2. Executing without a plan, entering the market blindly based on a hunch or FOMO without a predefined stop, loss, or profit target. 3. Ignoring trading psychology, allowing fear, greed, and ego to dictate execution rather than systematic rules. 4. Treating trading like a lottery, approaching the market as a get-rich-quick scheme rather than a professional business with operational costs. 5. Indicator overload, covering charts in dozens of conflicting indicators, resulting in analysis paralysis and erratic decision-making. 6. Providing liquidity to smart money, chasing parabolic green candles into major resistance, effectively acting as the exit liquidity for institutional market makers. The Institutional Trading Manifesto. The law of financial survival. Markets can remain irrational significantly longer than you can remain solvent. Your job is not to fight the market, argue with the tape, or hold a losing position to prove a point. Your absolute mandate is to protect your capital, accept the reality of the chart, and live to trade another day. Oh, help your readers eliminate the guesswork when selecting a strike price. Your digital edition requires a visual matrix. Choosing a strike price without understanding the interplay of the Greeks is the primary reason retail option buyers lose capital. They unknowingly buy contracts with high acceleration of time decay and insufficient structural probability. The Greeks' matrix, how moneyness alters contract DNA before a reader deploys capital. They must understand that an option's risk and reward profile shifts completely across three structural zones. In the money-high delta, these contracts behave more like the underlying stock. They carry intrinsic value, meaning they are insulated against minor pullbacks. While they require a higher initial capital outlay, their theta decay is linear and stable, making them the safest directional vehicles. AT, the money peak gamma, ATM options sit AT the absolute tipping point of uncertainty. Because a tiny move in the stock determines whether they expire worth something or nothing, gamma peaks here. Gamma measures the acceleration of delta. High gamma means the contract value explodes if the move is in your favor, but collapses with equal velocity if the trade goes against you. Time decay is aggressively high here. Out of money the theta cliff. OTM contracts are pure asphalt and hope. They contain zero intrinsic value. Their price is entirely made of time premium. As expiration approaches, if stock stays flat, theta accelerates exponentially, dragging the premium down to zero. Gamma is low, meaning it takes a massive violent movement in the underlying stock just to make the option premium respond. Interactive option strike price selection matrix. This deployable widget allows your readers to simulate how inspire option chains mathematical Greeks DNA alters in real time as they shift from deep in fair money preservation contracts to high risk out of fair money lottery tickets. State management let underlying price equal to 500, let active moneyness equal to ATM, OTM, strike static data set relative to 500 spot con strikes data equal to ITM, strike 490 name, deep in the money delta, 0.82, gamma, theta, 0.18, premium, $12.40, profile, low decay, high intrinsic value, risk. Conservative allocation, color, #10B981, ATM, container, inner TML equal to option strike and Greek dynamics matrix. Visualize how delta, gamma, and theta redistribute risk across an options chain corridor. Chapter Blueprint Notes. When explaining this widget to your readers in Chapter 8, use this accompanying analytical text to ground their interactive experience. Total option premium equal to intrinsic value plus extrinsic value. 1. The intrinsic protection cushion. Notice that when you select the ITM strike, the delta shifts to 0.82. This means that for every $1 movement in the underlying asset, your contract gains 82 cents. Because the contract has intrinsic value, time decay is relatively minor. 2. The gamma flashpoint. Toggle back to the ATM strike. Notice gamma surges to its absolute maximum level. Gamma is the accelerator pedal of delta. If the underlying asset moves from $500 to $501, gamma immediately shifts your delta from 0.50 up to 0.54. This is why ATM strikes offer the highest directional momentum returns, but carry massive premium volatility. 3. The OTM liquidation trap. Switch to the OTM strike. The delta drops to 0.18. The premium is incredibly cheap, which lures retail accounts into oversizing. However, look closely at the theta. It is losing a staggering amount relative to the premium size daily. If the stock stays dead flat for 24 hours, you lose nearly 40% of your position value overnight to pure decay. Trading rules and reminders. Risk management. Always cut small losses quickly. A small loss can be managed. A large loss can severely damage your account. Focus on preserving capital first and profits second. The strat setup. Wait for a confirmed outside bar action candle before entering a trade based on the strat methodology. Avoid anticipating the setup. Wait for confirmation. SPX Premium Collection Strategy. If not restricted by PDT rules, consider trading SPX spreads by placing both limit buy and limit sell orders. Aim to buy the bid and sell the ask whenever possible to maximize premium collection. Focus on efficient order execution rather than chasing fills. Market psychology. Look for areas where the market appears to be stalling or losing momentum. Monitor situations where option premiums become inflated or rapidly decay. Be prepared for moves that go against the majority expectation. Gap, up and gap, down days. On gap, up or gap, Down openings. Closely watch the first 15-minute SPX candle. The first 15 minutes often provide valuable clues regarding the likely direction and sentiment for the trading day. Trend confirmation entries. Long entries. Enter long positions only after 2 consecutive 15-minute bullish candle closes. Candles should have strong bodies and show clear directional strength. Avoid entering during consolidation or indecisive price action. Short entries. Enter short positions only after 2 consecutive 15-minute bearish candle closes. Candles should have solid bodies and demonstrate strong downside momentum. Avoid relying on candles with large wicks or weak closes. Candle quality. Prioritize full body candles that close strongly near their highs or lows. Avoid making trade decisions based solely on wick candidatos, as they often indicate indecision rather than conviction. Chapter 9. Self-awareness. The psychological edge. Trading is 90% psychology and only 10% strategy. You can possess an elite technical framework, but if your mind is chaotic, your execution will follow suit. Screen time, historical study, and market education make you capable of discovering high probability setups, but learning how to master yourself and avoid the bad trades is what makes you a consistently profitable trader. To survive in this game, you must adapt. If you do not, the market will eat you alive. 1. Practicing absolute self-awareness. To trade effectively, you must wake up and deliberately cultivate an attentive, present state mindset before you ever click of buttons on your broker platform. Observe your own awareness continually. Audit your current emotional state. If you feel frantic, vengeful, or distracted, you are highly likely to commit an expensive, unforced error. Analyze before execution. Pause and map out the entire landscape before risking capital. Ask hard questions. Is this setup actually inside my playbook, or am I chasing? Remove the emotion. Your sole objective is to remain disciplined, focused, and completely detached from fear. Treat trading like a clinical business system. Execute the predetermined plan without internal debate. The golden execution rule. Take your profits quickly according to targets and cut your losing positions even quicker. Cultivating your macro gauge. Never trade a chart in complete isolation. Take close, continuous attention to these core macro instruments to gauge the broader market structural direction. IG, at no limit trading. The VIX, to map out real-time implied market volatility and pricing risk. The US dollar and treasury bonds, to assess institutional liquidity flows and risk-off environments. Bitcoin, to measure the overall speculative appetite and retail momentum in the broader financial ecosystem. 2. The anatomy of a trading mistake. If you trade correctly, mistakes become your single greatest source of business growth. However, this is only true if you actively document them. You must map your emotions to your errors to prevent repeating them. The professional standard. Take clean screenshots of every single poor trade and file them away. Maintaining a visual journal filled with your worst trades acts as a harsh, necessary baseline reminder of what happens when rules are broken. The iceberg of profitability plus, what retail focuses on a or what actually builds the account equity curve. Line 153. Overtrading and the market. Make a trap. When you overtrade, your mind slips into a hypnotic state, leaving you highly vulnerable to falling on the wrong side of market psychology. Remember these structural market realities. 1. The market is forward-looking. The vast majority of breaking news events are already fully priced into the charts. 2. The logical retail trap. Frequently, the trade that looks fundamentally or logically perfect on the surface is a structured trap. Market makers routinely engineer these highly visible retail setups specifically to squeeze those exact positions and drain retail capital back into institutional pools. 3. The inversion principle. Sometimes, the inverse trade of what your immediate emotional impulse is telling you to do is actually the highest probability entry. When you find yourself spinning out into doubt, zoom out to a higher time frame. Ground your perspective strictly in institutional key levels, objective price action, and volume profiles. If you are still highly convicted on a macroeconomic or technical theme but unsure of immediate directional timing, protect yourself. Hedge the position by playing it both ways with structured call and put brackets. Take your profits cleanly on the winning side as it hits the very next major support or resistance barrier. 3. Trading exclusively in the now. Many market participants destroy their mental capital because they are entirely trapped in the past or paralyzed by the future. They completely forget to evaluate the present moment. The market itself does not create your internal stress. You create your own stress by projecting personal expectations onto random data. All that matters is what the tape is telling you right now through current volume, price effort, and immediate risk-reward boundaries. How to trade in the now. React, don't predict. Interact with price action and volume characteristics exactly as they print in the present moment, not how you think they should look. Accept risk up front. No individual setup guarantees a profit. Once you fully accept that the outcome of any single trade is uncertain, fear evaporates. Control your environment. Turn off external distractions, chat rooms, and conflicting voices. You are responsible for your own execution. Deconstructing trading fears. Uncomfortable must become your baseline comfort zone. Traders do not directly decide their success. They decide their habits, then their habits decide their success. Option: specific momentum management. When managing out of the money contracts, you must take your profits the absolute second your target hits during a fast, momentum-driven move. When an asset spikes violently, the premium on an OTM contract expands exponentially due to a temporary surge in implied volatility and delta acceleration. However, the moment that exact directional speed stalls, the option premium will decay with extreme velocity. Do not overstay your welcome. Take the money, secure the gains, and protect your baseline capital. On highly volatile, choppy sessions, tighten your stop losses significantly and scalp cleanly in and out of liquidity pools. The power of small gains. Trust the process over the profits. Become a disciplined, high-achieving student of the tape every day. Be patient. As the old saying goes, Rome was not built in one day. Capturing just a consistent 5% a day on your committed capital adds up to roughly 25% a week, which translates to compounding over 100% a month. We all know how accessible it is to extract 5% to 10% on an options contract within a 5 to 20-minute window when utilizing a validated technical edge. Small, repetitive, rational gains compound into astronomical figures over a 12-month horizon, and that does not even account for the large-scale macro runners that will naturally come your way when you are patient. 5. Trading Psychology 101. Mental health and longevity. Sometimes, unlocking profitability isn't about acquiring more market data. It is about learning how you uniquely react to real-time risk. Institutional data globally reveals a sobering truth. Anxiety, severe burnout, and depression run rampant among traders due to unmanaged exposure to high-pressure environments and capital volatility. When a trader enters a compromised psychological state, their risk of making compulsive, emotional, and catastrophic sizing errors skyrockets. Long-term stress degrades your sleep, ruins your immunity, and systematically destroys your decision-making capacity. Essential practices for professional longevity. Build true resilience. View every single loss not as a personal failure, but as a standard business expense and a valuable growth opportunity. Practice gratitude and keep your focus anchored entirely on the long-term equity curve. Physical and mental conditioning. Meditate daily to clear past emotional trauma and market scars. Work out consistently. Eat clean, nutrient-dense foods, and fiercely protect your sleep cycles. Your brain is your revenue generator. Treat it like an elite athlete's engine. Establish a rigid trading schedule. Limit your live screen interaction to 2 to 4 hours per day. You do not need to sit in front of blinking tickers all day long. The most lucrative institutional volume moves occur within specific windows. When you hit your daily profit target or your system stops generating clean setups, close the software and walk away. Adopt professional risk rules. Set absolute daily drawdown loss limits. Diversify your execution parameters and never over-leverage into a low-volume, unpredictable market. Keep your risk calm, calculated, and entirely distinct from your human ego. The final takeaway: create a positive risk-to-reward profile on every execution. Optimize your personal life. Protect your trading capital at all costs by cutting losers fast. And remember, the trend is your friend until the very end of that trend. Remember, if you cut a small loss, you cannot take a big loss. On a gap down or gap up, the first 15-minute candle on SPX should tell the direction of the day. Only enter long trades on 2 consecutive 15 minutes green candle closes, not consolidation, or enter short on 2 consecutive red closing candles, only solid full body candles. Chapter 10: Trading Technique and Strategy. Frameworks for Longevity. A trading strategy is not a magic formula, it is a business operations plan. Without a structured framework to govern your choices, you are simply gambling in a highly sophisticated arena. To extract consistent capital from the financial markets, you must establish a definitive methodology that balances system mechanics with strict risk guidelines. 1. Discretionary versus systematic. Execution. Traders fall into 2 primary schools of execution. Both are entirely valid, but mixing their foundations without a plan leads to catastrophic account failures. Plus mechanical automation bias, plus implicit memory driven, eliminates human hesitation. Looks like guessing 2 outs. Systematic traders, these participants operate like algorithms. They define rigid, objective variables and execute trades only when the market satisfies every condition simultaneously. This path is highly disciplined but structurally difficult, as you are attempting to automate edges across a landscape driven by thousands of participants with conflicting motives. Discretionary traders, these participants utilize contextual flexibility. They do not wait for paint, by numbers setups %. Their entries adapt daily based on market conditions. Discretionary trading relies heavily on intuition, a refined skill set developed over thousands of hours of real-time screen experience that cannot be learned from a textbook or video. The professional hybrid, most successful retail market participants survive by combining both approaches, employing hard systematic risk rules paired with discretionary contextual analysis. Mapping the battlefield. Regardless of your execution style, you must plot your structural boundaries prior to the opening bell. Daily. Mark the top and bottom of the candle bodies on the daily chart from the previous session. The SE zones form your foundational support and resistance corridors for intraday execution. 2. The Master Trading Plan Blueprint. Never click a button without a written document outlining your operational framework. If it is not recorded in writing, it does not exist. Your blueprint must explicitly address these structural components: strategic boundaries, execution metrics, exactly where, how, and why you enter and exit a trade. Target management, hard definitions for initial stop losses, trailing stops, and profit-taking targets. Market context, the specific environments under which your strategy has a verified edge and the explicit conditions that authorize you to exit an active position early. Capital allocation controls. Position sizing, the exact percentage of total capital allocated per execution. Drawdown firewalls, rigid daily, weekly, and monthly monetary loss limits. Once hit, active trading ceases immediately. Exposure caps, the maximum number of simultaneous positions allowed, alongside the maximum capital permissible within a single asset class. Operational protocol, strict parameters detailing whether you hold positions through major binary macro events or structural calendar blocks. Business infrastructure, sourcing workflows, the tools used to surface setups, e.g., automated technical scanners, manual macro lists. Capital directives, defining whether you are withdrawing profits regularly for active living income or compounding returns inside the account for long-term equity. Scaling, risk and tax reserves, a tactical contingency plan for setting aside a fixed monthly percentage for personal emergency funds and capital gains tax liabilities. 3. The 24 command-only rules of professional trading. 1. Prioritize liquidity. Trade exclusively in high-volume, liquid financial instruments where slippage is minimized. 2. Respect the drawdown cap. If your technical stop loss is triggered continuously across multiple consecutive setups, close your software for the session. 3. Banish revenge trading. Never attempt to make back money from the market out of frustration. 4. Know when to walk. If your initial position achieves your complete weekly profit target on Monday morning, cease trading immediately. 5. Anchor your stop loss. Never execute a trade without a hard stop loss. Once placed, never widen it to avoid taking a loss. 6. Never average down a loser. Do not add to a losing position hoping to lower your average price cost while the asset prints lower against you. 7. No setup, no trade. Never enter the market without an unambiguous, predefined technical signal. 8. Honor your entry checklists. Do not anticipate a trigger. Enter only after every single structural criteria is verified. 9. Demand asymmetric risk toward. Target minimum structural metrics of 1-5. Ideally, pursue setup showing clear 1-2 or 1/3 reward potential. 10. Stagger your capital. Never commit your entire operational account balance to a single trade simultaneously. 11. Segregate your capital pools. Never trade or speculate with core loan, term investment funds. 12. Eliminate debt financing. Never borrow funds or secure personal loans from family or institutions to fund trading or investment accounts. 13. Combat greed. Take what the market provides cleanly %. B. Do not let a profitable target turn into a losing trade because you are hunting for an unreasonable windfall. 14. Maintain clean charts. Do not clutter your workspace with dozens of overlapping technical indicators. Simplicity breeds clarity. 15. Ignore the call gurus. Never execute positions based on generic tip rooms, signal, alerts, or chat room recommendations. 16. Demand historical validation. Backtest every strategy comprehensively across multiple market cycles before risking a single dollar of live capital. 17. Narrow your focus. Do not juggle a dozen tickers at once. Track and trade no more than 1 to 2 clean stocks per session. 18. Avoid out-of-the-money traps. When buying options contracts, completely ignore cheap OTM strikes. Focus exclusively on deep-in, thin money or highly liquid the money options corridors. 19. The beginner's baseline drill. If you are a novice, commit to executing exactly 1 trade per day with a fixed stop loss for 30 consecutive days. Disregard the profit and loss outcome %. Be focused entirely on the perfection of your routine. 20. Capital preservation first. Prioritize defense. Before thinking about how much money a trade can make, analyze exactly how much capital you must protect. 21. Cut fast, hold firm, cut losing positions with ruthless speed, and allow your valid winning trends room to run. 22. Keep bet sizes small. Ensure no single execution size can severely damage your operational psychology or account longevity. 23. Avoid the chop. Sit on your hands during low volume, sideways, or erratic trading sessions. 24. Ignore the hype. Avoid trading stocks that are the focus of breaking retail news headlines. These tickers are easily manipulated and prone to severe volatility traps. 4. Constructing a probabilistic mindset. To think like a professional investor, you must establish a cognitive framework that aligns perfectly with a probabilistic environment. This requires absorbing 5 fundamental truths. Anything can happen. The market is an open system. You cannot control external participant responses. You do not need to know what will happen next to make money. Profitability is born from long-term statistical metrics, not accurate fortune telling. Wins and losses are randomly distributed. For any given technical edge, the sequence of winning and losing trades will be completely random. A 70% win rate edge can easily experience 4 consecutive losses. An edge is simply an indicator. It means one outcome has a higher mathematical probability of occurring over another. It is not a guarantee. Every moment in the market is unique. No historical pattern prints exactly the same way twice. The blueprint of a consistent winner. To step into your authority as a market professional, you must transform your core beliefs. Repeat these affirmations until they govern your routine. I am a consistent winner because I objectively identify my technical edges before taking action. I explicitly predefine the capital risk on every individual position. I completely accept the risk up front, or I gracefully let go of the setup. I ACT on my edges immediately without hesitation, reservation, or fear. I pay myself as the market makes money available, taking profits at targets. I continually audit my mental state for vulnerabilities or emotional errors. I recognize these rules as mandatory laws and I never violate them. 5. Standard institutional evaluation checklists. The quality buying checklist when identifying long-term growth equities. Hunt for highly rated companies showing explosive fundamental expansion metrics. The strategic selling checklist. Offensive selling. The 20 to 25% target rule. Lock in profits on standard equity positions when they climb 20% to 25% beyond a verified technical breakout level. The 3-week exception lift. If a high-quality stock surges over 20% within 3 weeks of a proper breakout, do not sell. Hold this asset for a minimum of 8 weeks to allow structural institutional compounding to unfold. Defensive selling. Macro environment warnings. Take immediate defensive action or raise cash if the broader market health metrics shift to uptrend under pressure or market in correction. The absolute capital rule. Always cut a stock if it falls 7% to 8% below your entry price. No questions asked, no hesitation tolerated. Technical breakdown triggers. Liquidate positions immediately if you witness 1. The largest single-day price decline since the run began, accompanied by the heaviest trading volume in months. 2. A sharp breakdown below the 50-day moving average on massive institutional distribution volume. 3. A decisive close below the 10-week moving average line on heavy volume. 6. The eradication of system mistakes without a trading plan. Every trade you place is an unforced error. A sound technical strategy generates your gross profit potential, but operational mistakes reduce your net income. The dollar cost error tracking exercise. Most traders drastically underestimate how many mistakes they make in a month. To fix this, you must run an audit. Track the exact dollar cost of every rule violation for 30 consecutive days. Write down what the mistake was and what it cost you financially. When you tally the data at the end of the month and see that your lack of discipline cost you an extra $2,500, $7,000, or $20,000 in lost profit or unnecessary drawdowns, that visual reality provides the exact psychological incentive needed to respect your plan. Incremental error resolution process. Do not try to fix your entire psychology overnight. Work on one single mistake at a time. 1. Identify your most frequent violation. 2. Prioritize this single mistake during your pre-market preparation routine. Brainstorm exactly how you will handle it. 3. Track your weekly frequency. If you reduce this specific mistake from 5 occurrences down to 2, you have successfully saved capital. 4. Once that specific bad habit is eradicated, move down the ledger to your next biggest operational mistake. 7. Identifying the market profiles. Failure to profile of or blames external factors or plus paralyzed when price prints aggressively against them, or allow small losses to run on pure hope or plus takes personal ownership of every portfolio outcome or plus maintains total mental flexibility, adapts to the tape LOA. Structural rules for long-term value investing to wrap your technical execution inside a resilient, timeless framework. Adopt these 10 core principles of capital allocation. Rule 1. Market investing is an incredibly rewarding endeavor, but it is exceptionally dangerous if you refuse to do the foundational analytical work. Rule 2. Your edge is not something you purchase from Wall Street experts. It is built upon investing in sectors, businesses, or consumer products that you already intimately understand from your everyday life. 184. Rule 3. The modern stock market is dominated by a crowded herd of institutional fund managers. This makes it easier for independent retail investors %. You can outperform the professionals by simply ignoring the short-term noise of the herd. Rule 4. Behind every single stock ticker is an actual physical corporation. Find out what that company is building, selling, and executing. Rule 5. In the short term, there is often zero correlation between a company's operational success and its fluctuating stock price. Over a multi-year horizon, however, there is a 100% correlation between corporate health and stock value. This divergence is exactly how fortunes are made. Rule 6. You must know exactly what assets you own, and precisely why you own them. Rule 7. Speculative long shots almost always miss their mark and destroy retail accounts. Rule 8. Owning equity positions is like raising children. Do not get involved with more than you can properly manage. A part-time investor has time to follow 8 to 12 companies closely, but your active portfolio should never contain more than 5 companies at any single time. Rule 9. If you run your checklist and cannot find a single attractive, undervalued corporation, put your capital safely in the bank. Wait patiently until a high probability opportunity presents itself. Rule 10. Never invest in a business without reviewing its financial standing. The most catastrophic, unrecoverable market losses stem from toxic corporate balance sheets. Always verify solvency before risking your capital. The Anatomy of Candlesticks. Chapter 11. The Strat. Price Action. The Strat Explained. This is a simple way to understand the Strat, a trading strategy that uses 3 types of candles: 1 second, 2 seconds, and 3 seconds. Understanding candles. Each candle shows the high and low prices in a time period. Let's learn about the 3 types of candles below. 1. It stays inside the last candle's range. Failed 2 seconds. When directional candles can't keep moving in the same direction, it's failure 2. A 2 fault if it starts to go in one direction. It starts to go in one direction but then reverses. Spotting reversals. How to identify changes in direction by combining. Why the Strat helps. The Strat lets beginners find good trades more easily. It doesn't rely on support and resistance or supply and demand levels, which can be more confusing. Many retail traders fail because they treat charts like abstract art, drowning their screens in lagging indicators. The Strat, a price action methodology created by Rob Smith, strips away the noise. It is an objective, rule-based framework built on a singular premise. Analyze how the current candle behaves relative to the previous candle's structural boundaries. The Strat does not predict what the market might do tomorrow %. It forces you to react mathematically to what price is executing right now. 1. The 3 universal candle types. Every candle across any time frame, from a 1-minute scalp chart to a monthly macro chart, can be categorized into one of 3 structural types based entirely on its range boundaries: directional, outside; type 2, type 3, high; type 1, the inside bar. An inside bar forms when the current candle's high and low remain completely contained within the high and low boundaries of the preceding candle. Market context. This represents balance, consolidation, and indecision. The analogy. Think of a type 1 candle as a coiled spring. The market is temporarily pausing, compressing energy, and trapping participants inside a tight corridor before an imminent breakout. Type 2. The directional bar. A directional bar breaks either the high or the low of the preceding candle, but never both. 2 up breaks cleanly above the prior candle's high, signaling aggressive bullish expansion. 2 down breaks cleanly below the prior candle's low, signaling aggressive bearish expansion. Market context. Type 2 candles show that one side of the market has taken definitive control of the order book. Type 3. The outside bar. An outside bar breaks both the high and the low of the preceding candle simultaneously. Market context. This represents peak volatility and intense conflict. Price expands violently in one direction, sweeps liquidity, reverses course, and sweeps the opposite side. Strategic value. Outside bars expand the trading range and demand close attention, as they routinely form the foundation of institutional broadening formations. 2. The power of the failed 2 reversal. The engine of the Strat's high probability setups is the concept of a failed 2 reversal. This condition tracks real-time momentum exhaustion and reveals exactly where aggressive market participants are trapped. The failed 2 up. A failed 2 up occurs when the current candle successfully breaks above the prior high, but buyers completely fail to maintain momentum. Sellers aggressively reject the extension, driving price back down until it breaks below the low of that very same candle. The trapped capital effect. All retail momentum buyers who chase the initial breakout are instantly trapped underwater. Their forced liquidations fuel the downward reversal. The failed 2 down. A failed 2 down prints when price breaks below the prior low, but sellers exhaust themselves. Whales absorb the orders and drive price aggressively upward until it breaks above the high of the directional candle. The trapping mechanism. Short sellers who anticipated a structural breakdown are trapped. Their subsequent stops triggering provides the rocket fuel for an explosive bullish advance. 3. Core Strat playbook setups. By combining 1 second, 2 seconds, and 3 seconds, we discover highly repeatable, structurally sound execution patterns. The 2 to 1 minutes 2 trend continuation. This sequence is the premier choice for trend following traders because it pairs expansion with localized structural consolidation. 1. Phase 1. A strong directional expansion candle establishes clear momentum. 2. Phase 2. An inside bar pause prints, building energy. 3. Phase 3/price breaks out beyond the inside bar's boundaries in the direction of the original trend, signaling a high probability continuation entry. The 3 to 1 minutes 2 reversal, a highly effective setup designed to capture institutional turning points following a massive expansion of price volatility. 1. Phase 1. An outside bar creates an expansive, volatile range expansion. 2. Phase 2. Price compresses into a tight inside bar corridor. 3. Phase 3/a directional breakout prints, slicing through the inside bar's range to initiate a structural trend reversal. The 1 to 2 minutes 2 momentum reversal. This configuration relies entirely on the mechanics of a failed 2 pattern to exploit an exhausted breakout attempt. 1. Phase 1. Price prints an inside compression bar. 2. Phase 2. Price breaks out to the upside, appearing strongly bullish. 3. Phase 3/the upside move fails completely. The candle reverses hard, breaking down below its own low to trigger a short entry. The 1 to 1 minutes 2 compression breakout. 1. Sequence. 2 consecutive inside bars followed by a directional breakout candle. 2. The mechanics. Double inside bars represent extreme range compression. The longer price remains coiled inside these tight layers, the more violent the eventual structural breakout becomes. 4. Macro principles. TFC and broadening formations. Time frame continuity. Time frame continuity is the backbone of strat risk management. Before placing a trade, check if your execution time frame aligns with the broader market. Full bullish TFC, the daily, weekly, and monthly charts are all simultaneously printing type 2 up structures. Full bearish TFC, the daily, weekly, and monthly charts are all concurrently printing type 2 down structures. The structural edge, when multiple time frames align, you have institutional tailwinds at your back. Trading with full TFC dramatically minimizes your exposure to choppy, low probability countertrend environments. 5. The comprehensive multivariable options checklist. To ensure your technical analysis translates to profitable options execution, run through this comprehensive checklist before risking a single dollar of live capital. Section A. Top down structural analysis. Weekly chart audit. Establish macro context. Is the higher time frame trending or consolidating? Mark major weekly support resistance levels. Daily chart audit. Confirm current sentiment alignment. Identify active breakout patterns. Locate type 1 inside bars to use as upcoming breakout levels. Horizon synchronization. Ensure your intended intraday entry direction aligns directly with higher time frame continuity. Section B. Strat setup and level validation. Pattern identification. Verify an unambiguous strat. Pattern is actively printing. Level proximity check. Note where your entry sits relative to key structural barriers. Are you buying calls directly into major daily resistance? Always buy near demand support and short near supply resistance. Volume confirmation. Ensure the breakout trigger is accompanied by a noticeable surge in trading volume relative to preceding sessions. Pullbacks should occur on low volume. Section C. Indicator confluence. Exponential moving averages. Verify price is trading above both the 9 EMA and 21 EMA for long positions, or below them for short positions. Look for cross confirmations. Relative strength index. Slice verify bias. RSI greater than 50 supports bullish entries. RSI less than 50 supports bearish entries. Audit for overextended extremes. The 200 SMA and VWAP confirm structural institutional bias. Maintain a long bias when price is above the 200 SMA and intraday VWAP. Maintain a short bias when price trades below them. MAC tracking. Verify the MACD line has crossed cleanly above the signal line for a long entry, or below it for a short entry. Section D. Options. Specific metrics. Moneyness corridor. Filter out cheap, dangerous out of the money options. Select liquid in the money or highly responsive AT, the money contracts. Liquidity check. Ensure the bid ask spread is tight. Avoid wide spreads that create instant execution drag. Verify robust open interest and daily contract volume. Implied volatility assessment. Determine if 4 is artificially elevated due to an upcoming binary event like earnings. Avoid buying options when 4 is at historic extremes to prevent severe 4 crush. Expiration curve maturation. Ensure the contract has adequate time for the pattern to resolve. For day trades, prioritize high liquidity. For swing trades, buy ample duration to insulate against early time decay. Section E. Hard operational execution limits. Risk to reward metric. Confirm you can clearly identify an explicit technical stop loss in a corresponding target that yields a minimum 1.5 risk-reward ratio. Trading plan alignment. Confirm this specific setup completely satisfies the rules detailed inside your written operations document. If the setup feels forced, step away. Capital preservation is a position. Pattern cheat sheet. ChatGPT, Gemini, Rock AI trading prompts. Prompt 1. Weekly watch list based on upcoming catalysts, earnings, and the strat setups. 66 as CT as an expert options trader. Give me a watch list of 5 high probability tickers for this upcoming week. Only include stocks with key earnings, major economic catalysts, or news events coming up. For each ticker, break down the catalyst or news expected, whether it aligns with a strat setup, whether it's near a key order block or gap fill area, and if the options change shows unusual volume or OI buildup. Format this like a trader's prep sheet. Tell me what time frames the strat setups are on as well. Prompt 2. Daily Catalyst plus Flow Momentum Scanner. ACT is a pre-market trading analyst. Give me a list of 5 to 10 tickers that have significant catalysts, earnings reactions, or breaking news this morning. For each, tell me the key headline, current pre-market price, movement, whether there's a clean strat setup on the daily 4H, and if options flow is aggressive in either direction. Rank by momentum potential and liquidity. Tell me exactly what time frame the setup is on as well. Prompt 3. Options flow plus the strat screener for breakout moves. Scan today's market and give me a list of 5 tickers that have the strongest options flow in combination with a strat setup. Also, check for proximity to order blocks or gap fills. I want to trade high, conviction setups only. Include strike plus expiry most traded. Tell me exactly what time frame the strat is on as well. Prompt 4. Economic and earnings calendar summary. Summarize the most important economic data, Fed speakers, earnings reports, and other macro catalysts happening this week that could move the market. For each item, explain the exact date, time, expected impact on volatility, and which sectors or stocks are most likely to be affected. Make it actionable for options traders. Prompt 5. Build a trade plan based on news plus strat setup. Take this news headline. Based on this, tell me if there's an actionable trade on a major stock like SPY, CSLA, NVDA, APL, AMD, or Meta using the strat. Check if there's a 2-to-1 minus 2 or 3-to-1 setup forming on the daily or 4 hours, and whether price is near an order block or gap. Add options flow info if available, and suggest a trade idea with entry stop, target. Fibonacci secrets. Chapter 12. Enforcing system rules. I wish someone had handed me these exact rules when I first stepped onto the trading floor. They were not compiled from academic textbooks. They were written in blood, forged through painful mistakes, blown accounts, and lessons learned the hard way. If you truly embrace these principles, you will dramatically accelerate your development as a market professional while entirely avoiding the catastrophic errors that wipe out retail traders. Print these rules, save them, tape them next to your monitors. This chapter is not market theory. It is pure tactical survival. The 10 Commandments of Capital Preservation. Rule 1. Size every trade as if it could go to zero. Long options positions carry a built in mathematical reality. They can expire completely worthless. The sooner you accept this fact, the sooner you can manage risk professionally. Never risk an allocation that would significantly damage your account or compromise your execution psychology if the trade fails entirely. The baseline boundary: risk no more than 3% to 3.5% of your total account equity on any single options deployment. Example: if you manage a $10,000 portfolio, your absolute maximum risk exposure per trade is strictly restricted to $300, $350. Even if you hit a string of several consecutive losses, you remain fully in the game. Professional traders focus on baseline survival first. Opportunities return endlessly percent. B. Lost capital does not. Rule 2. Plan every trade prior to entry. Never click an execution button without a structured, written setup. Before you buy an options contract, explicitly define your structural parameters, core mechanics. Your setup should target a minimum asymmetric metric of 2, 1 reward relative to your risk. When these parameters are locked in before your money is on the line, emotion is completely neutralized during live price fluctuations. Rule 3. Never chase price. Chasing a parabolic move after expansion has already unfolded is a definitive way to destroy an account. By the time your fear of missing out surfaces, institutional algorithms and elite traders are already actively dumping their positions to take profits. The professional alternative: sit on your hands and wait. Wait for structural pullbacks, wait for retests of high volume demand zones, and wait for objective candle confirmation. Opportunities in the market are infinite. Your capital is finite. Rule 4. Prioritize consistency over home runs. Amateur traders are chronically obsessed with hunting for the next speculative 500% lottery ticket. This toxic mindset inevitably leads to reckless overleveraging and emotional decision making. Shift your focus entirely toward consistent account growth. Small, disciplined gains compounded systematically create staggering long-term wealth curves. Focus on mastering a repeatable process. Professional traders think in horizons of months and years, never individual sessions. Rule 5. Journal every execution without exception. If you do not track your statistics, you cannot optimize your business. Your trading journal must actively log entry and exit timestamps, the precise setup utilized, time of day variables, broad market conditions, your exact emotional state during execution, and the structural lessons learned. Review these metrics weekly. Your journal will expose your recurring behavioral flaws and highlight your true mathematical edge. Rule 6. Master one single setup before expanding. A primary reason retail accounts fail is strategy hopping. A trader will run breakouts on Monday, attempt supply and demand on Wednesday, and pivot to erratic scalping by Friday. Stop complicating the process. Choose one single technical setup and master it completely. Backtest it across multiple cycles, study its nuances, and execute it repeatedly. True consistency is born from pristine repetition, never from system complexity, or the strategy discipline loop, or greater than or never hover. Rule 7. Establish a rigid daily maximum loss limit. Every professional operator requires an absolute line in the sand where live execution ceases for the day. Without a strict firewall, localized drawdown instantly transforms into catastrophic revenge trading. Establish a daily loss threshold. 2 consecutive losing trades in a row. An absolute 5% to 7% drawdown of account equity. A predetermined hard dollar amount. The second that limit is breached, turn off your monitors. The market will open again tomorrow. Rule 8. Respect the mechanics of time decay. Time is a relentless force working directly against options buyers. Amateur traders focus entirely on directional charts while completely ignoring theta attrition. Even if you are structurally correct about the eventual direction of a stock, your option premium can easily bleed out if the asset consolidates. Intraday timing guide. Focus your active long option strategies during the peak liquidity windows, the first 2 hours after the opening bell and the final hour of the trading day. Avoid forcing options positions during the low volume, choppy midday consolidation zones where theta eats premium alive. Rule 9. Protect your mental capital. Your account balance is not your only operational asset. Your confidence, executive focus, and structural discipline are equally critical. An emotionally drained trader is an erratic, highly dangerous market participant. Safeguard your mental capital. Take extended breaks after experiencing stop-outs. Respect your baseline rules and maintain realistic expectations. A calm, uncluttered mind is an elite competitive advantage. Rule 10. Ruthlessly honor your stop-loss. A stop-loss exists as your ultimate survival tool. Moving or removing a stop-loss because you hope an asset will turn around transforms a controlled business expense into a devastating, unrecoverable account blow-up. Losses are an ordinary cost of running a trading business. Professionals do not avoid losses. They control them with iron discipline. Small losses are completely manageable. Large losses destroy months of hard work. When your stop is hit, exit immediately. Discipline always beats hope. Formulating and enforcing system rules. The boundary separating a professional trading operation from a speculative retail account is the transition from intuitive decision-making to rigid, algorithmic rule enforcement. An edge in the financial markets is not a vague feeling. It is a statistically verifiable anomaly that can only be captured through identical, repeatable execution. If your entry, exit, and risk parameters fluctuate based on your morning move or your current intraday profit and loss, you do not possess a trading system, you possess an expensive hobby. This chapter details the mechanics of engineering a bulletproof rule architecture and the psychological governance required to enforce it. 1. The anatomy of a robust trading rule. A professional system rule must be binary. It cannot contain room for interpretation, nuance, or mid-session improvisation. The moment of execution, your cognitive load should be zero. Your only task is to recognize if a pre-defined condition has been met and to ACT without hesitation. 5-win. Minute chart. On the 5. Every operational rule you formulate must contain 3 distinct components. 1. The trigger condition, an objective, quantifiable state of market structure, volume, or premium pricing. 2. The execution parameter, the precise action required, including order type and size. 3. The risk invalidation, the exact point where the structural logic of the trade is broken, requiring an immediate market exit. 2. Formulating your rule and erratic conditions. 220. The regime filter. If the daily average true range expands beyond 200% of this 20-day moving average, position sizing must be automatically scaled down by 50% to account for heightened volatility. Layer 2. Set up trigger rules. These rules remove intuition from the entry process. They ensure you only deploy risk when the mathematical probabilities favor your system. The 3 reason mandate. Every tactical entry requires 3 independent structural validations. The premium verification. For SPX premium scalpers, entries are strictly prohibited on contracts that have not reached a minimum institutional volume threshold or whose spreads are wider than 5% of the total premium cost. Layer 3. Risk and trade management rules. Once a trade is live, your primary objective shifts from profit extraction to capital defense. The pre-calculated invalidations, stop, loss and take, profit limit orders must be submitted simultaneously with the entry order. Moving a stop, loss further away from your entry point to give the trade room is a terminal operational offense. The profit locking mechanism. When a trade reaches 2 rands, the stop loss must be systematically adjusted to break, even plus transaction fees, or a partial profit of 50% must be liquidated. Layer 4. Post trade and capital boundaries. These rules protect you from systemic account drawdowns and behavioral spirals. The daily max loss boundary. If your account realizes a daily net drawdown equal to 2% of total equity, all open orders are canceled, the trading platform is locked, and execution is suspended until the next session. The consecutive loss rule. 3 consecutive losing trades within a single session triggers a mandatory 2-hour operational timeout to reset the operator's nervous system. 3. The enforcement protocol. Eliminating behavioral drag. Formulating rules is a simple exercise in writing %. Enforcing them requires rigorous psychological conditioning. The typical retail trader fails because they treat rules as flexible guidelines. The institutional professional treats rules as unyielding structural laws. The psychology of rules. Your subconscious mind keeps a precise ledger of your self-discipline. Every time you violate a system rule and escape with a winning trade, your brain rewards bad behavior. This builds a psychological trap that guarantees a massive, uncontrolled capital liquidation down the road. To ensure strict compliance with your rule architecture, you must deploy an operational enforcement routine. 4. Grading your performance. The compliance rate. To build consistency, you must separate your financial outcome from your execution quality. A losing trade that followed every system rule perfectly is a successful execution. A winning trade that violated your entry rules or chased a breakout out of FOMO is a failed execution. Calculate your system compliance rate at the end of every week using this simple formula: compliance rate equal to ×1. If your compliance rate sits below 95%, you are actively undermining your mathematical edge. You must stop trading live capital, Return to a simulated sandbox environment and rebuild the discipline required to execute your plan without error. True wealth in the marketplace is not built by predicting the future. It is built by flawlessly enforcing your system rules, one identical trade at a time. Chapter 13: Market Mechanics, Advanced Hacks, and Wealth Blueprint. To extract consistent profits from modern markets, you must look beneath the surface of basic charts. This chapter details the technical nuances, advanced institutional options positioning, and macro asset management protocols required to transition from a retail participant into a high-earning market professional. 1. Understanding quantitative options pricing. The Black-Scholes framework. Professional options operators do not merely analyze stock charts. They trade the relationship between an options market price and its theoretical fair value. The Black-Scholes model utilizes 5 core structural variables to estimate this value. Theoretical option value equal to F. By understanding this model, you can instantly determine if an asset is mispriced. If a contract trades significantly above its theoretical model value, it is overvalued. If it prints below, it is undervalued. Your objective is to buy premium when it is cheap and efficiently priced, and avoid buying when premiums are heavily inflated. Volatility mechanics versus directional trading. While amateurs guess direction, professionals look at volatility dynamics. Volatility trading seeks to exploit fluctuations in premium cost independent of directional asset movement. Implied volatility represents the market's forward-looking pricing of expected movement and uncertainty. High 4 inflates options premiums, low IV deflates them. A primary retail blunder is purchasing options directly into periods of extreme volatility spikes. The moment the event passes, EV elapses dramatically, triggering a severe forward crush that decimates the contract's value even if the stock moves in your intended direction. 2. Intraday Tactical Playbook. The CEST blueprint. When preparing to trade any session, you must view entries through the strict operational filter of CEST: conditions, entry, stop, target. If any letter of this framework is undefined, the trade cannot be taken. Gateway. The CEST or conditions, market environment, alignment, or entry, confirm technical trigger level or stop, hard invalidation, exit line, target, predefined structural take, profit. The first 15, minute structural audit. The opening 15 to 30 minutes of the session reveal institutional intent. Watch candle structure closely. Wick rejections. If the opening 15-minute candles consist of long upper wicks testing the previous day's highs, the asset is printing structural weakness. If a candle body closes cleanly above or inside the previous day's low, momentum may. Volume validation. Always look for high volume pin bars at key historical support or resistance levels to validate reversals. If you are in an options trade and price prints an exhausting wick rejection against your position, exit immediately. If a candle closes with a strong full-size body, hold and monitor for institutional follow-through. Continue in that directional vector, directional bias and momentum management. To stay on the winning side of institutional order flow, anchor your intraday execution to directional bias. Bullish bias setup. Only execute long entries when the daily candle is green and price trades cleanly above the intraday VWAP. Bearish bias setup. Only execute short put entries when the daily candle is red and price trades safely below the intraday VWAP. On highly directional, straight gas bullish market openings, never chase the initial vertical green bars. Wait patiently for a structured corrective pullback toward the pre-market low or VWAP to secure a low-risk entry. Ride the trend up until the RSI registers overextended, overbought conditions paired with red wick rejections entering key daily resistance. Take your profits cleanly into that strength. 3. Institutional market structure and options volume analysis. To navigate short-term options pricing, you must monitor institutional market makers and liquidity cycles. Gamma regimes and the volatility switch. The broader market's volatility characteristics shift completely based on aggregate options positioning, known as the market gamma profile, net long gamma. The market environment is stable, structured, and non-volatile. Price pullbacks are rapidly absorbed by market maker hedging, leading to orderly mean reversion. Net short gamma. The market environment becomes highly volatile and erratic. Movements are amplified as market makers are forced to sell into drops and buy into rallies to hedge their books. When the VIX hits or exceeds 30, it typically signals a short-term volatility extreme %. Expect a sharp institutional sell, followed by a rapid counter-trend short, covering retracement. Volume versus open interest sweeps. Always audit the relationship between daily trading volume and open interest on the option chain. If daily volume on a specific strike price climbs significantly higher than its existing open interest, it tells you that brand new contracts are actively being minted and open. Review the time and sales tape to decipher if these aggressive blocks are buyers hitting the ask or sellers slamming the bid. A massive accumulation of call open interest concentrated at a near-term strike can trigger an institutional gamma squeeze, forcing market makers to aggressively buy the underlying stock to hedge their short call exposure, creating a rapid upward price spiral. 4. Advanced execution growth hacks. The swing catalyst confirmation. When a daily chart prints an unusually massive high volume expansion bar, it signals institutional accumulation or distribution. You can safely swing options positions for a 2 to 3 day continuation run in the direction of that bar. The Audi Friday OTM burn. Never purchase out of the money out options on a Friday afternoon expecting a miracle breakout. Statistically, market makers harvest these premiums to zero. If you hold long OTM options that briefly pump green on an early morning pop, sell them immediately. The post-quad witching cycle. Pay close attention to quadruple witching expiration sessions, the third Friday of March, June, September, and December. Once these massive institutional derivative positions expire, the market completely resets its structural liquidity cycle and initiates entirely new capital trends. The macro indicator health check. Use specialized tools like the MMFI to track the percentage of stocks trading above their 50-day moving average. This metric provides an unfiltered look at true internal market breadth, showing you whether a rally is being driven by the broader market or just a few overextended mega-cap stocks. 5. Building long-term generational wealth. Trading is a high-performance business designed to generate rapid revenue. However, true long-term wealth is built by systematically migrating your short-term trading profits into enduring, appreciating global assets, distribution engine or digital and equity asset allocation. The wealth, high-velocity trading, long-term allocation or short-term options profits, dollar, cost average or scalp momentum gains or Bitcoin Ethereum core or intraday income generation. Index funds. Take a fixed percentage of your weekly trading profits and redirect them into long-term investments. Implement a rigorous, automated dollar cost average framework into major digital assets like Bitcoin and Ethereum, alongside broad equity market index instruments. When macro corrections unfold, such as the historic bear market drawdowns of late 2022, view those drawdowns as generational buying opportunities. When Bitcoin retraces to major historical support blocks or index exchange, traded funds print major multi-month lows, deploy your sideline cash aggressively. Only deploy capital that is entirely separate from your everyday living expenses, essential needs, or household bills. The law of propensity and your wealth mindset. To survive as an investor, you must honor the economic law of propensity. Do not fixate solely on the daily cash value of your portfolio. Instead, focus entirely on your marginal propensity to save and your commitment to continuous learning. Income, savings rate. Generational wealth. A high marginal propensity to save ensures that as your trading income scales, your capital reserves grow exponentially rather than expanding your lifestyle. The author's final charge. The path of professional trading is a continuous journey of self-education, emotional mastering, and clinical discipline. The strategies and rules laid out across this book are designed to serve as your personal technical edge. Approach the markets each morning not as a gambler seeking excitement, but as a sniper waiting patiently for a highly calculated, high-probability setup. Protect your capital with fierce discipline, stay humble before the price action tape, and remain completely dedicated to your process. Journal trades every day. Review what you did wrong and right. Wait for confirmation. Before entering a trade, pay attention to how you are feeling when entering a trade. Analyzing emotion. Always wait for double-test confirmation. Remember, if you cut a small loss, you cannot take a big loss, no matter what. If the trade goes against me, I'm getting out. Close the position. Watch NASDAQ and SPY for key levels. QQ will show you what's really going on. My only job as a trader is to wait for proper setup on the daily chart. If SPY is above the 20-day moving average, buy the LAST 10 minutes AT close. And if below the 20-day MA, short the LAST 10 minutes into close or LAST 5 minutes. Example, SPY sold down to 632. Look for a rally to 634.35 and take profit. Trading View Indicator. Spaceman BC key level V13.1 will automatically mark key levels on charts. 1-point reversal rule. Once a trade goes back 1 point against your position, get out of the trade. Save your capital. Remember, no PDT. If you enter a trade and it goes in profit in the first 15 minutes to 20 minutes, then reverses back the other way after 15 minutes, exit the trade. Reanalyze. Pay attention to the NASDAQ QQQ price action as well when trading SPY. Look for big body candles and use the data to trade around. Ask, what does the body candle mean on the 15-minute chart for the day? Look at T options 4 deep in the money chain. Strike lowest price of option premium divided by 2. Then divide it again by 2 again. Example 7,500. Strike trades AT 24,000 AT. The lowest of day divide by 2,200. Drive by 2 again 600. The next day 300 may be a good buy on that option to sell for 1,200. Look left. Check last 4 days. If the lowest price is 2,000 on previous days by 2 equal to 10 is too low a premium, which is unsafe. Do not take the trade. It will most likely expire worthless. When in an options trade, if you lose structure or support on your position, quickly cut your losses and sell it for a loss before it becomes a bigger loss. New no PDT strategy. Only enter a key level, hold for 15-minute candle continuation until first reject candle, sell and wait until it breaks out of consolidation to re-enter in the trading trend. Do not trade the chop sideways action. Wait until breakout to go long or breakdown to go short. Pay attention to options premium prices, calls and puts, high of day, low of day, and especially end of day last 30 minutes, 10 minutes. Please do not continue to hold a losing position if the trade goes against you. B as soon as it's down 30%, get out as soon as it goes the other way. Do not be call biased and do not be put biased. Wait for a reaction and then react. Above VWAP bullish, below VWAP bearish. Market sell off AT 130. Dead cat bounce AT 330. Wait for the outside 3 action candle on the strat. Best time to trade is the power hour, end of day. Last 30 minutes to 15 minutes after. You have stalked the option premiums all day. You will get the lowest price on decayed optio. On a bounce or short into the last 15-minute close, look for a 2 to 2.5 point move and take profit. Although it may go higher 3 to 4 points, but most of the time it will reverse. So lock in gains and take profit. No PDT. Keep buying and selling the spread on SPX. Put limit buy and sell orders AT the same time to collect the premiums. Buy the bid, sell the ask. Look for the market to stall out and kill premiums and do what most won't expect to happen. On a gap down or gap up, the first 15-minute candle on SPX should tell the direction of the day. Only enter long trades on 2 consecutive 15-minute green candle closes, not consolidation, or enter short on 2 consecutive red closing candles, only solid full body candles. Option premiums from 945 to 12/45 are completely different from the premium prices from 1 to 320. Then 330 to close at 4 will be most volatile. Always count a 5 to 7 point move range, and the day should be ready for reversal. Don't try to buy at the best price and don't try to sell at the best price. Enter AT setup and sell AT target. Ask, am I making good decisions? Are these decisions reasonable? Puts into close, below 20-day moving average. On morning trade around 9:45, 9:50 continue may last for 3 15-minute candles flashing 45 minutes before reversal and or chop. Master these rules. Internalize this framework and execute your plan. Let's step out onto the field, take ownership of our financial futures, and build the generational wealth you are destined to achieve. Let's get it. Stay disciplined and make it happen. Chapter 14, Trading Psychology, Flawless Execution, and Strategic Mechanics. The most sophisticated trading algorithms and analytical frameworks are entirely useless if the human operating them is a slave to impulse, fear, or ego. Trading is a psychological martial art. To survive, you must transform your mind from an emotional battleground into a clinical, systematic decision-making engine. This chapter bridges the gap between inner mental architecture and institutional-grade execution mechanics. 1. The psychology of elite execution. Bringing the mind to the light present. The retail trader is constantly haunted by the ghosts of past losses or paralyzed by the phantom of future uncertainty. To trade professionally, you must anchor your consciousness exclusively to the current moment. Understand this core truth: your mind is a programmatic magnet. If you approach the screen with a chaotic, fearful, and negative mindset, you will naturally interpret objective market data as a threat, leading to defensive and costly execution errors. Conversely, cultivating a clear, positive, and focused mental framework allows you to see market structural shifts exactly as they are. The law of attraction, a trader's alignment routine. To stabilize your execution, you must actively condition your central nervous system before the opening bell rings. 1. Decompress the nervous system. Breathe deliberately. Remove the physiological fight or flight response before looking at the order book. 2. Establish pure intentional clarity. Define your precise financial objectives with certainty. 3. Isolate the emotional state. Visualize your intended structural success. Internalize the feeling of flawless execution until it generates calm, positive conviction. 4. Relinquish rigid expectations. Detach your ego from the outcome of any single individual trade. Redefining flawless execution. Amateurs mistakenly believe flawless execution means buying the absolute bottom tick and selling the exact top tick of a daily range. In reality, attempting to catch the absolute extremes is a mathematical trap. The true metric of success, flawless execution, means perceiving an objective structural opportunity on the chart and acting upon it instantly without fear, hesitation, or internal conflict. The execution spectrum, or flawless execution or terrible execution. Trade the living chart, trade the accrued P&L, or follow the pre-written plan, follow emotional impulses, or react coldly to system or triggers, hesitate, chase, and hope. Or the market is not a vehicle for rapid wealth extraction. Trying to force rapid gains out of the market is a guaranteed setup for systemic failure. True longevity belongs to the patient operator who systematically compounds small, high probability gains over an extended time horizon. 2. The archetype of the institutional trader. To move beyond the limitations of retail performance, you must deliberately adopt the specific traits, technical skill sets, and cognitive behaviors that define top-tier institutional operators. Systematic problem solving and establish unshakable capability to break down complex market dynamics into structural, rule-based variables. Quantitative risk mastery, an acute, unemotional understanding of taking risk within highly uncertain conditions, anchored by algorithm theory, data analysis, and statistical probabilities. Strategic agility, the operational capacity to intake a constant stream of new, conflicting market information, process it dynamically, and react with zero friction. Uncompromising resilience, taking extreme ownership of your outcomes, executing with total integrity, and possessing the psychological stamina to overcome localized drawdowns to achieve macro scale. Exploiting inefficiencies, a continuous intellectual curiosity to identify pricing anomalies, transform unstructured data sets into clean trading signals, and thoroughly master a dedicated asset corridor. 3. Understanding the core law of supply and demand. Every fluctuation on a stock chart is governed by a singular foundational law, the law of supply and demand. Price supply increases, demand declines. Price supply constricts, demand grows. When these two competing economic forces are plotted visually on a chart, their intersection marks the equilibrium price, the exact market clearing valuation where active demand matches active supply. The continuous structural movement of price across your screen is simply the living process of real-time price discovery as buyers and sellers search for this moving equilibrium level. 4. Transitioning to professional consistency. The conflagration of euphoria, a major obstacle to long-term Term consistency is the failure to recognize when you have crossed the threshold from standard, healthy self-confidence into a dangerous state of market euphoria. Euphoria blinds your risk awareness, leading to oversized positioning and a subconscious belief that you can no longer lose. Eliminating internal conflict. Operating with complete psychological freedom requires a deep, fundamental acceptance of one core axiom. You do not need to know what is going to happen next on a trade basis to make consistent money. Thinking, assuming, or believing that you know exactly what a specific asset will do next creates an unrealistic expectation. When the market fails to fulfill that expectation, your brain interprets the incoming price data as a direct personal threat, triggering 4 distinct trading errors. The 4 core retail errors or 1. Failing to define risk parameters before entry. 2. Defining risk, but refusing to execute the stop, loss or 3. Allowing a pristine winning trade to turn into a loser or 4. Choking a stop, loss too tight out of fear of missing out or. Professionals look at trading as an exercise in probability. They define their edge, map their precise risk parameters, manage position size mathematically, and execute their plans with clinical, effortless ease. 5. The structural edge of futures trading. For active intra-day scalping and momentum execution, trading futures contracts offers an elite structural alternative to standard equities and options vehicles. Bypassing the PDT rule, futures markets are entirely exempt from the pattern day trader restriction, allowing you to execute unlimited day trades without maintaining a minimum balance of $25,000. Optimize capital allocation. Trade highly liquid global indices with minimal initial capital requirements using micro contracts or scale up to standard mini contracts. Asymmetric tax advantages. Futures contracts fall under the Section 1256/60/40 rule, meaning any capital gains are automatically taxed as 60% long term and 40% short term, regardless of how long the trade was held. Institutional execution efficiency. Enjoy continuous, high liquidity order books with near zero spreads, instant transaction settlement clearing, and around-the-clock trading capabilities running 24 hours a day, 5.5 days a week. 6. The mechanics of treasury bond auctions. As an equities and derivatives trader, you must closely monitor macro liquidity vectors. Government treasury bond auctions wield an immense direct influence over the broader stock market by altering systemic interest rates and shifting institutional investor sentiment. When a major bond offering prints, such as an institutional auction of 10-year notes, it establishes a baseline rate benchmark for consumer debt, credit instruments, and mortgages. The tailed auction mechanism. If an auction tails, it means institutional demand was weak, forcing the government to offer a higher yield to attract buyers. This triggers immediate selling pressure across existing treasuries, sending yields higher. Because spiking yields raise the cost of corporate capital, the equity markets typically experience sudden, aggressive selling pressure in response. In the critical 15-minute window immediately following a volatile treasury auction, equity index futures experience heightened structural volatility, sharp directional expansions, and a massive surge in trading volume. Primary dealers dominate this space, track their footprints to capture the true directional momentum. The tactical SPX premium and derivatives playbook. Trading the S&P 500 index options requires a deep respect for mathematical premium behavior, structural execution, and precise timing. Because SPX is a cash-settled, highly liquid index product with zero risk of early stock assignment, it represents the premier arena for institutional premium scalping. To trade it profitably, you must view premium through a strict quantitative lens. 1. The core strategic parameters. Track in the money premium behavior. Monitor how ITM options contracts behave throughout the active session, with special focus on the final 30 minutes before the closing bell, when theta decay and localized volatility acceleration peak. The 6. Strike boundary rule. To insulate your capital from early morning volatility traps, locate the previous day's closing price, count out 6 full ITM strikes from that level, and patiently wait for the options premium to settle and cool before initiating an entry. Pre-calculate all pricing targets. You must mathematically define your precise entry premium cost and your target exit premium. Price before submitting an order. No impulsive market execution is permitted. Isolate intraday scenarios before the opening bell. Build explicit scenario maps for both bullish expansion, bearish distribution, and range bound chop based on overnight futures levels and major pre-market liquidity pockets. Update these zones dynamically as new price discovery unfolds. 2. High probability SPX execution and profit rules. Structural level invalidation. Eliminate blind execution. Only deploy capital when price actively interacts with major structural levels of interest. Focus your strategies on ITM contracts that are systematically losing intrinsic value to capture highly predictable, orderly premium decay profiles. Premium velocity and target modeling. Utilize the pricing of the options chain itself to project your technical targets. Calculate expected options premium values, AT major overhead resistance and underlying support zones. If you are scalping short, term out, off the money contracts on verified momentum breakouts or breakdowns, apply the 1-to-3 premium ratio rule. When an option contract moves rapidly from a premium value of 100 to 300, anticipate a sharp technical retracement unless market trend velocity is exceptionally strong. Power, hour, and close guidelines. The late day ITM transition. If you are holding an OTM contract and a late day directional push drives it cleanly into the money during the final minutes of the session, lock in your profits instantly via a sell limit order. Reversals in the final minutes can erase an entire position in under 30 seconds. The 10-minute momentum cascade. If the broader market is aggressively dumping into the final 10 minutes of the trading day, favor long puts. If the market is systematically squeezing higher into the closing bell, favor long calls. Never fight the dominant closing trend. Premium quality filter. Restrict your active trading loop to high caliber SPX contracts that demonstrated true institutional demand by reaching a premium level of at least 5,000 earlier in the session. Avoid low volume, illiquid strikes whose high of day premium stalled out around 2,000. The ATM liquidity audit. Before deploying capital near the close, scan the options chain to identify the highest concentration of open interest on the immediate AT. The money calls and puts. This data highlights exactly where institutional liquidity, defensive market maker hedging, and potential explosive gamma movements are clustered. Chapter 15. The technical indicators and macro reference manual. Trading at an elite level requires total mastery of market terminology. If you do not understand the vocabulary, the underlying mechanics, and the technical tools at your disposal, you are operating at a severe disadvantage. This chapter serves as your definitive reference manual, the precise lexicon that supports your strategy, psychology, and structural execution. Section 1. Options fundamentals in the Greek's core contract structure. Call option. A financial derivative contract granting the buyer the right, but not the obligation, to purchase an underlying asset at a specific strike price within a defined time frame. Put option. A financial derivative contract granting the buyer the right, but not the obligation, to sell an underlying asset at a specific strike price within a defined time frame. Notional contract size. The total volume of the underlying asset controlled by a single options contract. For standard equity derivatives, one single options contract controls an underlying block of exactly 100 shares. Contract multiplier. The numeric value utilized to calculate the total premium cost of an options contract. For equity options, this multiplier is 100. Underlying asset. The core financial security from which an options contract derives its pricing behavior. Cash. Settled index. An options contract linked to a broad market index that settles directly in cash rather than requiring the physical delivery of underlying shares upon expiration. Expiration horizons and moneyness. Expiration date. The explicit calendar date and time when an options contract becomes legally void and ceases to trade. Leaps. Specialized. Long dated options contracts featuring extended expiration horizons extending up to 3 years into the future. Strike price. The fixed, contractually predetermined price at which the underlying security can be bought or sold by the option holder. AT the money. A structural state where the underlying asset's current spot price is trading directly at or immediately adjacent to the contract's strike price. In the money swipes contracts containing real realizable intrinsic value. For a call option, this means the stock price is trading above the strike price. For a put option, it means the stock price is trading below the strike price. Out of the money/contracts containing zero intrinsic value, composed entirely of speculative time premium. For a call option, the stock price sits below the strike price. For a put option, the stock price sits above the strike price. Premium composition options premium represents the total market cost of an option contract calculated via a precise formula. Premium equal to intrinsic value plus time value. Intrinsic value, the absolute cash value built into an in-the-money contract, representing the mathematical difference between the asset's current spot price and the option strike price. Time value, the speculative premium pricing added to an option contract based on the amount of time remaining until expiration, tracking the probability of the contract moving deeper into the money. The mathematical Greeks. Delta, a measurement tracking the expected dollar amount change in an option's premium for every corresponding $1 directional move in the underlying asset. Delta also serves as a rough proxy for the mathematical probability of a contract expiring in the money. Gamma, a derivative tracking the absolute rate of change in an option's delta for every $1 movement in the underlying security. Gamma measures the acceleration velocity of your contract's sensitivity. Theta, the measurement of an option's systemic time decay. Expressed as a negative value, theta quantifies the exact premium amount drained from the contract each day as it moves closer toward expiration. Vega, the metric tracking an option contract's price sensitivity to fluctuations in implied volatility. Vega determines exactly how much an option's premium will expand or contract for every 1% shift in the asset's aggregate forward profile. Section 2, Market Sentiment, Behavior and Terminology. Market sentiment orientations. Bullish, a market bias characterized by the expectation that asset prices will expand upward. Bearish, a market bias characterized by the expectation that asset prices will distribute downward. Market sentiment, the aggregate psychological, behavioral, and emotional tone driving participants across a specific marketplace at any given time. Short squeeze, a rapid, violent upward price spike triggered when short sellers are forced to aggressively buy back shares to cover their short positions, creating a compounding loop of upward buying pressure. Pump and dump, an illegal market manipulation scheme involving the artificial inflation of an asset's price through false or exaggerated positive promotion, followed by insiders rapidly liquidating their positions at peak prices. Rug pull, a sudden, malicious withdrawal of all trading liquidity by core developers or market insiders from a digital asset pool, leaving retail buyers unable to execute exits. FUD/slash to widespread, often intentional dissemination of negative, vague, or misleading information designed to undermine investor confidence and drive asset prices down. FOMO, a powerful psychological state where a trader abandons their disciplined strategy to chase a late-stage price expansion out of fear of being left behind. Operational order mechanics. Bid price, the maximum price that buyers are actively willing to pay for a security on the open order book. Ask price, the minimum price that sellers are actively willing to accept to part with the security on the open order book. Bid-ask spread, the raw mathematical difference between the highest active bid and the lowest active ask price on a contract's order book. Tight spreads indicate high liquidity. Wide spreads signal execution slippage. Limit order, a precise execution order submitted to the marketplace to buy or sell an asset at an explicitly chosen price or better. This order protects you from slippage. Market order, an aggressive execution order designed to fill immediately at whatever current pricing is available on the open order book. Warning, market orders expose you to severe execution drag in volatile conditions. Day order, a standard operational order instruction that automatically expires and cancels at the closing bell if it is not filled during the active session. Going long, the ACT of buying an asset, equity, or derivative contract with the structural expectation of profiting from an upward advance in price. Averaging down, the highly dangerous strategy of purchasing additional units of a declining asset at lower prices to reduce the average cost basis of the overall position. Market capitalization, the total aggregate market dollar value of a corporation's outstanding shares, calculated by multiplying total shares outstanding by the current spot price. Float, the exact number of a company's outstanding shares that are freely available for public retail and institutional trading, excluding locked or restricted insider shares. IPO, the initial transition process where a privately held corporation sells shares to public institutional and retail investors on a regulated exchange for the first time. Secondary offering, an additional issuance of new public shares by an already publicly traded company, typically diluting the existing share pool to raise corporate capital. Portfolio, the total collective aggregation of investment holdings, equities, options, futures contracts, digital assets, and cash reserves managed by an individual or enterprise. Margin, borrowed capital provided by a brokerage house to a trader, utilizing the existing assets within the portfolio as collateral to amplify purchasing power. Stock split, a corporate action that increases the overall number of outstanding shares while proportionally lowering the share price, leaving the total market capitalization of the firm completely unchanged. Section 3. Technical indicators blueprint to operate professionally. You must understand how indicators function mechanically. Never treat an indicator as a standalone signal. Avoid cluttering your charts with too many tools, and always require clean price action confirmation before committing capital. Indicators exist to support your decisions, never to replace them. Trend identification tools. Simple moving average (I), a lagging technical overlay that calculates the average price of an asset over a specific number of preceding candles, smoothing out localized price noise to highlight the dominant directional trend. Exponential moving average, a dynamic moving average that applies higher mathematical weight to the most recent price candles. EMAs respond much faster to real-time price breakouts, making them premier tools for active momentum tracking. MACD, the trend, following momentum oscillator that tracks the changing relationship between two separate exponential moving averages, charting crossovers and histogram expansions to signal momentum shifts. Momentum oscillators RSI, a bounded momentum oscillator that measures the velocity and magnitude of recent price directional shifts. Traditional parameters flag an asset as overbought when the metric prints above 70, and oversold when it dips below 30. Stochastic oscillator, a precision momentum tool that compares an asset's specific closing price to its total price range over a predetermined period, charting potential turning points by tracking structural closing strength. Stochastic RSI, a hypersensitive indicator that applies the stochastic formula directly to the standard RSI output, designed to maximize clarity around localized momentum reversals before they appear on the main chart. 280. CCI, an oscillator designed to measure an asset's current price deviation from its statistical average price, pinpointing cyclical trend transformations and structural overextended states. Volatility and boundary layouts. Bollinger Bands, a volatility envelope consisting of a central moving average paired with two standard deviation bands that automatically expand during high volatility environments and contract during low volatility compression phases. ATR, an indicator that calculates the average trading range of an asset over a set number of candles, measuring market volatility to help traders set structurally sound stop losses. Donchian channels, a technical boundary indicator that charts the highest high and the lowest low of an asset over a specific time horizon, mapping the structural breakout corridors of a trending market. Pivot points, objective support and resistance price targets calculated mathematically from the preceding session's high, low, and closing values. Section 4. Essential macroeconomic concepts. Inflation, a broad macroeconomic state characterized by a persistent rise in the aggregate prices of goods and services over time, resulting in a corresponding erosion of consumer purchasing power. Stagflation, a toxic macroeconomic environment featuring a stagnant economic growth rate, elevated structural unemployment, and persistently high inflation. CPI, a critical macroeconomic data point that measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods. The monthly release of CPI figures serves as a major catalyst for institutional market repositioning and violent trend expansions. Conclusion: the blueprint for longevity. Revisit these chapters often. Study them, absorb them, live by them. If you need to read these rules every morning to stay aligned and disciplined, then make it a mandatory part of your pre-market routine. These principles were built from real experiences, wins, losses, painful lessons, and massive personal growth. No strategy works every single day, and no two trading days are ever identical. But these rules give you an edge. They sharpen your judgment, strengthen your discipline, and help you recognize exactly when the moment is right to ACT. My hope is that this book not only saves you money, but also helps you earn more of it so you can move closer to your goals, your dreams, and the life you envision. Whether that means building generational wealth, securing financial freedom, or rewarding yourself with the luxuries you once thought were out of reach, the path begins with discipline, knowledge, and consistency. Stay motivated, stay humble, stay dedicated. You are fully capable of becoming the professional trader you were meant to be. Disclaimer: this book is for educational and informational purposes only. Nothing contained within these pages should be interpreted as financial advice, investment recommendations, or an offer to buy or sell any security, cryptocurrency, derivative, or financial instrument. Trading involves substantial risk, including the potential loss of all capital. Past performance does not guarantee future results. The strategies, examples, and concepts presented reflect the author's personal opinions and experiences and may not be suitable for every trader or investor. Readers are solely responsible for evaluating their own financial decisions and should consult with a licensed financial advisor, tax professional, or other qualified expert before acting on any information provided in this book. The author and publisher assume no responsibility or liability for any losses, damages, or consequences resulting from the use or misuse of the information contained herein. By reading this book, you acknowledge that you participate in financial markets at your own risk. Let's get it and make it happen. Speak your affirmations into existence. Think them into reality. Then put in the work to bring them to life. Markets rip up and markets go back down. What you walk away with is not by chance, but it is your decision. Instagram at @StrateCash, Twitter X/TikTok at @OneFlyHustle. At Stocks updated daily on all platforms. The Strat Combos.